Welcome everyone to day 2 of the MFS Macrofinance Society-Wharton Virtual Summer School 2020, first ever virtual and summer school for the Macrofinance Society. Hopefully this is something that we can continue in whatever format that the future makes possible. So today we have the topic of macro finance across borders, and this is going to be a joint lecture. So it's my pleasure to introduce my co-author, Adrien Verdelhan, who is going to do the first half of the talk, and I will then continue after we take a break sometime roughly halfway through. So as a reminder, the ground rules. Please put your comments in the chat box. And Anna here, Anna Teresa Helmke, sorry, Anna at Wharton will relay these questions to Adrien. And if you want to raise a hand, if there is something quick that you want to say, please go ahead and do that. All right, so Adrien, the virtual floor is yours.
Thank you. Thank you very much, Nick. Welcome, everybody. So we're going to talk about microfinance across borders. We're going to do half and half. I'm going to do the first part. Nick is going to do the second part. So why should we talk about this in the first place? What's the difference? Well, the difference is the exchange rates. That's it. Between LA and New York, you have many different things to study, but there's no exchange rates. Between the US and the UK, there is one. And if you're particularly in this field a little bit biased, you could actually argue that it's maybe the most important price in every country. It clears the import and export markets, clears their foreign assets and liabilities. These are really, really big markets. And so if you want to study one price, maybe that's the one. So I'm sure you've seen the DIS numbers before, right? You know that the foreign exchange turnover is over $5 trillion. When I was a PhD student, I was taught, and actually even before I went to Chicago, that I should study serious things like the equity market or the bond market. Let me just show you a little bit of a comparison between the turnover on the currency markets and turnover on the equity market. It's basically 18 times bigger. So the fact that I trade a lot might not be the most important thing in the world, but along many dimensions, you could make the case that the exchange rate is a very, very important topic. But actually, the reason I want to talk to you about this today is not because it's a big thing. It's because there are a lot of things we don't understand. Many more things we don't understand than the ones we do understand. And I see it as a very positive way. It means that we have a lot of puzzles, a lot of open questions, and that means a lot of research opportunities. So right now, when I think about international finance, I think of it as a kind of a very vibrant field. And I just have an hour and a half. So it's going to be a super limited tour. And just due to this time constraint, I think we could talk about this for 3 days. And so I need to apologize up front. I'm going to miss many important contributions. There are many people I'm not going to cite. I'm not going to be able to do justice to their work. And I'm just going to do a very simple overview. And then Nick is going to dig deeper in one of maybe one of the hottest topic right now. Okay. But let me apologize first. It's very incomplete what I'm going to do. Now, the way I organized my talk is around 2 ideas. First, it's microfinance. So what do you expect? We're going to talk about risk, right? So the first part of my talk is going to be about exchange rate returns and aggregate risk. And I'll go over a simple benchmark just to fix ideas and then show you basically, again, the big picture, what we've learned over the last 15 years. And I'll end with a simple benchmark in terms of model, again, to just give you ideas of what the kind of work we could do in the next 10 years. And then I'll move to the second part, which is actually even more puzzling. There are right now on the currency market, thing is in one of the biggest markets in the world, there are returns without risk. And so I want to show you that if you've not seen it before. I want to show you how it connects international finance to our literature. I'll go over rapidly intermediary-based asset pricing. And again, I want to do a kind of a preliminary list, if you want, of the open questions in microfinance, because I see this as a fantastic lab for us to study. So that's the plan. Okay, let's start. Let's start with the simple present value. So you all know Kemba-Schiller. the decomposition of the price dividend ratio. It's a beautiful accounting equation if you want. There's the same in international finance. The present value of exchange rates. It goes back to Campbell and Clarida in 1987. Fruit and Ramadari used it beautifully in 2005. And if you want to derive it, it's very simple. Start from the definition of a currency excess return. So that's what I have in the middle of the screen. The expected currency excess return is equal to the interest rate difference and the change in exchange rates. So let's go slowly. I borrow at the US interest rates, IT. I invest at the foreign risk-free rate, I star. So far, so good. Okay. But what may happen is that the exchange rate of the country I invest in versus the one I borrow at could change. And so here I define the exchange rate in foreign currency per US dollar, which means that when the exchange rate ST goes up, it means that the dollar appreciates. If the dollar appreciates when your money is abroad, it's not good. That's why you have the minus sign in front of the expectation of the change in exchange rate. Now, when you look at this excess return, it's the basic object in international finance. And why? Because there's only one source of risk here. It's the value of the exchange rate at the end of the investment period. You know the interest rate at which you borrow at today. You know the interest rate at which you invest. The only thing, you know the exchange rate today too, of course. The only thing you don't know is the exchange rates at the end of the investment period. Now you play with this little definition and maybe put the value of the exchange rate today on the left-hand side, move the rest on the right-hand side. And what you're going to see that by iterating forward, you can derive very easily this simple accounting definition of exchange rates, where the log of the exchange rate today, ST, is equal to the expected short-term interest rates differences. IT is at home, I star is foreign, plus the sum of the future risk premium, plus the infinite value of the limit value of the exchange rates. Now, when you look at this equation, I know it started like a tautology, so it's just an accounting definition if you want, but it tells you what you should study. The exchange rate today reflects the future cash flows, a little bit like the Campbell-Schiller on equity. The cash flows here means maybe short interest rate differences, I star minus IT. It also reflects future risk premium. And so you see, these are the two things we want to study. We want to study interest rates, we want to study risk premium. And you can immediately see the dollar appreciates when the foreign short-term interest rate goes up or the currency risk premium goes up. Now, this is, again, a tautology if you want, but for a long time, it was not really used for a very simple reason. We couldn't find any clear evidence of a time-varying currency risk premium. So it was like, okay, this accounting definition tells me that the log change in exchange rate should depend on future interest rate. Okay, let's study future interest rate because there's nothing else. What I want to show you today as kind of a rapid overview of the field is that now we have a lot of evidence that we have time-varying risk premium to study in currency markets, and it means that we have interesting drivers of exchange rates to study. There is hope in some sense. That's the point I want to make. And to do that, I need to just look at the data. So I'm going to now have a purely empirical part of this talk and just show you a little bit what we've learned on currency risk. Now, the story on currency risk actually starts in Boston around 250 years ago with a pretty cool pamphlet written by this guy, Douglas, doctor, and it's a big mistake. I'll tell you that story another day. But it looks okay. At first, what's the story? Well, in today's term, it would be the following. Imagine that the interest rate is 1% in the US, 3% in the UK. Well, the pound should depreciate by 2%. Why? Well, because if it doesn't, then everybody is going to borrow money in the US at 1%. So the interest rate should go up. Everybody is going to lend money in the UK at 3%. So the interest rate there should go down. And so if I see interest rate differences that actually remain steady, like it has to be, but everybody expects the exchange rate to depreciate by the interest rate difference. And so that sounds cool. That sounds okay. But I want to say, again, it's really wrong. Now, to show, to find a kind of a test of this simple idea, it took us 250 years. And you needed the rational expectations revolution to find a simple way to test this. If people have rational expectations, what they expect is pretty much what's going to be realized, plus some noise, some shocks, called epsilon t on this slide. And thus you can test the UIP by regressing the change in exchange rates on the interest rate difference. And the first test is due to Trian, 1979. Fama gets a lot of credit, but it comes only 5 years later. And if you run this simple regression, I'm sure you know, right? You're gonna get a slope coefficient less than 1. You can safely reject that it's not 1. It's very often actually negative, but the thing is that interest rate explain nothing about exchange rates, so, or very little, so the R square is very, very, very low. Now, I spent some time in this literature, so I can tell you there are more than 300 publications, academic publications, on this regression since 1990. And maybe I suggest that we don't add more, okay? So that we've run this regression enough. Now, let me show you maybe just one last time, and then we don't need to look at this anymore. What does UIP really mean? If the uncovered interest rate parity condition was the right way to think about the world, and people were rational, this is how the world would look like. On the horizontal axis here, I have interest rate difference between two countries and on the vertical axis, I have some fake data. I just built, using MATLAB, what would be the change in exchange rates if UIP was a correct description of the world. And it would look like this, and kind of a cloud, but you would see a clear link. Okay, so it will not be on the 45-degree line because there's a difference between what people expect and what's realized, but there will be a clear link. Now, these are really fake data, completely fake. So let me show you the truth. This is the truth. And so here, every color is a country, every point is a month, and there's very little, right? So this idea that we can explain exchange rates just looking at the interest rate difference, I think this is no point. Like, I'm not sure we needed 300 publications on that, but for sure we can stop, right? This is not the way to go. So if we go back and see what we can learn from those regressions, you'll see immediately that UIP is just the same thing as risk neutrality. When you say that the expected change in exchange rate should be equal to the interest rate difference, you're basically saying there shouldn't be any excess return. So again, if you borrow at the risk rate in the US in IT, if you invest at the risk rate in the foreign country, I stop, and you bear the exchange rate risk, you should not expect any excess return according to UIP. Now, we've just seen that UIP fails miserably in the data. So what does it mean? Well, you can just rewrite the expected excess return. You know that the change in exchange rate is not equal to the interest rate difference, but using the regression result, you're going to see that if beta is not 1, you have already a little bit of evidence that expected excess returns should move with the interest rate difference. So there should be a time varying risk premium, and that has been known for a long, long time. The problem is that interest rates explain so little about exchange rate changes that it's difficult to actually really find anything when we just look at one currency at the time with those kind of time series. So why is it so? I think you should, you clearly know it because the exchange rate changes look really much like any other equity return or bond return. It looks like a random variable. So for the fun here, I just picked 3 exchange rates, and the embarrassing thing, that's maybe Alzheimer, but I forgot which ones. And so I think one is the pound versus the dollar, maybe one is the yen, but I don't know which one. And there is one for sure, but it's just me having fun with MATLAB and drawing random numbers. And of course, I cannot tell you which one is which, and you cannot either. And that's the point. Exchange rates look very much like random variables, like many other asset returns. So that's why it's so difficult to study exchange rates. That's also why many people thought it was not even worth it, because it's just, you don't want to spend your life studying randomness. But of course, you know better, right? There's something very interesting to study in exchange rates. And so the way I'm going to try to show you that is going back to what we did, with Hanno a long time ago, and with Nick too. We just built portfolios of currency excess returns. So I said the object of interest is still a simple currency excess return. You borrow at home at the risk-free rate, you invest abroad at the risk-free rate, you take on the exchange rate risk, and study the properties of those excess returns. Now, instead of doing it one country at a time over a time series, we're going to do it in a cross-section by building portfolios of currency excess returns the same way, if you want, Fama and French have done it for equity returns, right? So the first time we did it, we worked at the annual frequency, and we had in mind a very kind of classic macro finance framework where what matters somehow is consumption growth. And in bad times, if an asset is risky, in bad times you lose money, right? And maybe we can measure bad times with consumption growth. So we tried that. I'm going to show you that first. And then we moved at higher frequencies, and there actually a clear factor structure appears. I'll show you that. There's a very interesting paper by Hassan and Manu in the QG that shows you the link between the time series and cross-sectional. I'm going to go fast here. So this is the first evidence we add. It shows you how old we are, because I am, because the sample stops in 2002. At that time, it was a lot of work to build this large sample of countries starting in the 50s or the 70s. And here we have 8 portfolios. So countries are sorted by the level of the short-term interest rates at the end of every quarter or the end of every year in this table. And then you think about what would be the return of a US investor borrowing in the US and investing in the set of countries you see in the first portfolio, or investing in a set of countries in the second portfolio, and so on. And what you see is that it is a clear cross-section of excess return from minus 2.3% on average per year to 2.9%, for example. It lowers a little bit in the last portfolio because these are super high inflation countries. But what you see here are very significant, very large returns. Actually, if you look at the Sharpe ratios of a strategy, would go short the first portfolio, meaning you would borrow in low interest rate countries, and you would go long high interest rate countries. This is, of course, known now as a carry trade. Look at the Sharpe ratio of that strategy. It's as big as the Sharpe ratio you would get on the S&P 500. So the risk premia that we have to study on currency markets are as big as the one people see on the equity markets. And of course, the same puzzle are gonna apply. How can we explain such high risk premium? So that was with just looking at the average currency return. I can show you there is actually a link. That's almost like macro 101. There is a link with consumption growth. It turns out that the returns on those carry trades tend to be low in bad times when you define bad times by low consumption growth. And if you're not completely convinced by any kind of regression, just think about what happened in 2008. I'll show you what happened in the last few months too. Clearly in 2008, 2009, the high interest rate currencies depreciated, the low interest rate currency appreciated. And so if you borrow in low interest rate currency and you invest in high interest rate currency, you get killed on both sides of your trade. You're losing money clearly in bad times when consumption growth is very low. So that's basically what you could see at the annual frequency. If you look at higher frequency, actually, there's even more information that shows up. And you can clearly see a factor structure, and that's the work with Nick. So here we can play the same trick. Build portfolios by sorting countries on the basis of their short-term interest rates. You can do this every month. You rebalance your portfolio every month. In the first portfolio, again, you have the low interest rate currencies. In the last portfolio, you have the high interest rate currencies. And you can look at the excess return a US investor would get by borrowing in the US and investing in each portfolio. Now, I'm going to show you this simple table. It has the first panel has the same message as the previous one. It turns out that this time it's on a smaller sample where the excess returns are more precisely measured. We can discuss that later, but you see the same message. If you borrow in the US and invest in low interest rate currency, you lose money on average. If you invest in high interest rate currency, you make money on average. And of course, the carry trade is going short the first portfolio, going long the last portfolio. Now, when you get a cross-section of excess return on currencies like on everything else, you want to see if you can explain it with risk. And risk is about covariances, co-movement between the returns and some kind of risk factors. So consumption growth was one very natural starting point. but it's not clear that the aggregate consumption should explain everything. You can also just go in different routes, thinking about what Fama and French have done when they built the cross-section of equity returns based on the size of the firms or their book-to-market ratios. Their next move is actually to build a risk factor out of those returns themselves, right? And that's what we can do here. So you can build a risk factor by looking at the high interest rate currencies minus the low interest rate currencies. Look at this exchange rates, high minus low. And this is an exchange rate that doesn't depend on your base currency. You can define it with respect to US dollar or another one, doesn't matter because it's a difference in exchange rates. And what you can see is that those portfolios, they tend to load more and more on this risk factor. So it's really the Fama and French exercise. You see from a negative loading to a positive loading across portfolios. Now, the thing is that here we're still explaining returns with returns, which is a little bit first point, but not completely satisfactory. But there is more actually, and that's where I think the risk story has some bite. You can build a risk factor without using any exchange rates. Just measure volatility on equity markets, country by country, and then just take the average. So what you have is a pure world measure of volatility, if you want, again, without any exchange rates. And you're going to see, of course, the classic time series where you have spikes, right? In each time you have a big crisis. Now, if this is your risk factor, meaning the assumption here is that high volatility times at the world level are bad times, then you can compute again the beta, look at how the currency excess return can move with this measure of volatility. And that's what you have on the last panel of this slide, from positive betas to negative betas. So what those betas mean? Or it may mean something super simple. In times of high global volatility, the high interest rate currencies tend to depreciate. The low interest rate currencies tend to appreciate. And think again, what is the carry trade? The carry trade is about borrowing in low interest rate currencies. If it appreciates, it means I need to reimburse more, not good. And the carry trade is about investing in high interest rate currencies. If they depreciate, not good, I'm also losing money. So those differences in betas are exactly what you would expect in a finance 101 story. You're going to lose money in bad times when bad times is defined by high volatility. Okay? So this is the way to just show it. I can show you with a couple of graphs. For the fun, preparing for this, this talk, I just decided to update what we had done with Hanno and Nick before. And so it seems to actually to work pretty well. So what you see here is the 45-degree line graph, the classic graph in asset pricing. On the vertical axis, you have the actual mean excess returns. So just data, look at the average excess return you get by investing in those different portfolios. And on the horizontal axis, you have the predicted mean excess return, which is just the beta times the market price of risk, right? And if the asset pricing logic were to work perfectly, everything would be on the 45-degree line. It's not the case, but it's pretty close. So clearly the idea that exchange rates are purely random and there's nothing to study, well, you can see that's clearly not true. There are a lot of things to study in exchange rates. Now, this is one way to show it. There's actually a more convincing way, I think, to show it, because there are even less, not even a regression involved. And here's the one. The first panel is the average excess return from low to high. If you have a low excess return and a high excess return, what you want is borrow in the first one and invest in the last one. And what I'm showing you on the second panel in red are just the average returns in the same portfolio, but when global volatility is high, defined by 2 standard deviation above its mean. And here you see the risk story again. By borrowing in the US and investing in high interest rate countries, on portfolio number 6, you make a lot of money on average. I showed you the previous Sharpe ratios, very high. But what's going to happen in bad times? You're going to lose a lot of money in bad times. And that's the risk, the basic risk story that we always go for, right? You'll get compensated for the risk of losing money in bad times. Now, because I cannot resist, I also wanted to look at what happened in the last few months. Let me start with the 2008 crisis. As I told you, the post-2002 sample is kind of an out of sample for me. And at first, people made a lot of money on the carry trade, but then they lost everything during the crisis. And that happened exactly at the time when uncertainty was for super high, volatility to be more precise. And what happened this spring? The exact same thing. Of course, we are now in a recession. I don't have the gray bands because it's not official yet, but of course we are in a recession, and the carry trade lost more than 20% exactly at the same time when volatility spiked. So the risk story about exchange rates is relatively simple to see. There's there, but that's just the beginning. So let me just go back a little bit and see where we go next. I started with a simple accounting definition of the exchange rate. So let me I bring it back here. The exchange rate today depends on the expected interest rates and the expected currency excess return. At first, we didn't have any evidence that there was any time varying risk premium. I think now we do. And it's actually even better than what I showed you, because I just showed you one. But there is much more evidence of time varying risk premium in currency markets. People have found this by building portfolios, not just on the level of interest rate, but the slope of interest rates, by looking at the country size, by looking at realized and implied FX volatilities, by looking at past returns, by looking at large equity losses, deviations from purchasing parity. I'm sure I forget some here. And if you think about what kind of evidence we still need, there are still some opportunities here, because the more risk premium we find, the more potential mechanism we find in order to understand exchange rates. So if you think about the research in this field, there are still many people who are looking for other signs of risk premium and time varying risk premium. So that's a big part of the research that can be done in this field, of course. But there's something more. We found the evidence for risk premium, but the next step, of course, is to explain what's risk premium. And it's a very fair point to say that we have a lot of work to do there. And by the way, we're in good company. Huh? It's not like everybody agrees on why the French factors exist, right? It's a bit of the same for the currency markets. We need to understand what we see in the data. We need to understand why those risk premium exist. And I think Nick will show you a little bit more about how to think about that. At the broad level, I think we need to figure out what are the key frictions. Are the key frictions in terms of international trade? Are they in terms of assets trade? In terms of market segmentation? We need to work more on that. Now, in order just to show you a little bit of the kind of theoretical work that is ongoing and has been done recently, and the kind of theoretical work you could do yourself, I'm going to introduce a very useful benchmark. It's not perfect, but it helps just to organize ideas. So I'm just going to go back to the complete market assumption. But before I go there, maybe I should stop. Nick.
I suggest there's some questions that go to sort of things you did further back. So why don't you address those? And well, since I interrupted you, I'm happy to relay them to you.
Okay, go for it.
Can do it later. So going back to kind of one of your first slides when you used the fruit and Ramadari decomposition, there's a question from Sung Young Kim. That decomposition assumes that the real exchange rate is stationary, imposing transversality condition on long-run exchange rate. In other words, deviations from PPP eventually die out. Is this really a non-trivial assumption? At least for emerging market countries, Balassa-Samuelson effect, for example, can lead to persistent deviations in PPP. And I know you've done work on that, of course, so I'll let you're probably going to want to talk about this a little bit.
That's a very good question. It's true that you can write the same accounting definition of exchange rate, not in terms of the nominal one, but in terms of the real one. And in there, what you assume is that the real exchange rate is stationary. I think there's a lot of evidence for that. It seems to be, the real exchange rate seems to be mean reverting relatively slowly, but seems to be mean reverting. We don't see real exchange rates exploding. Maybe Zimbabwe would be a counterexample. The way I wrote it, you may have noted, I actually was a little bit more ambitious. I wrote it in terms of the nominal exchange rate, which is like assuming that somehow this limit exists and the nominal exchange rate converges. It doesn't explode. I think it's actually a very good assumption. First, again, in the data, we don't see exchange rates, numerical exchange rates exploding. But seems like, okay, let's go to point. I think we can actually find conditions in terms of the persistence, if you want, of the stochastic income factors, where this is actually a very natural assumption. But in order to make this point, I would need the complete market benchmark. So maybe I won't go further. It's a very good question. Yes.
You may be able to get it to it later once you talk through kind of the model. There is a couple maybe related questions. There's a question from Jay. Is there any standard framework to think about the exchange rate relationship to real macroeconomic quantities like consumption, investment, saving, asset price, etc.?
I'm going there.
You're going to talk about that. And finally, and again, I think a related question from Sun. We know from Bacchus-Smith that consumption growth are disconnected from exchange rates. How do I reconcile that with the fact that carry trades, form of consumption growth are profitable, according to your paper with Hannah?
Oh, that's a great question. Let me take this rapidly. This is a great question. The way to reconcile the two statements is the following. Unconditionally, exchange rates do not move with a consumption growth. It's only when you condition on the level of interest rates that you can see something, right? So if I look at one particular country, say the UK versus the US, and I run a regression of the change in exchange rate between the pound and the US dollar and consumption growth or consumption growth differences across those two countries, I'm not going to find anything. Like the Bacchus-Smith result is a very strong result. It's there. You can relate that to Messi and Rogoff too. It's there. There's no question. The only little signal that we found was when we were building those portfolios, and the magic of the portfolio played in the sense that a lot of idiosyncratic noise cancel out. And we were conditioning on the level of interest rates. That's what you get by building those portfolios. You're now looking at the covariance between exchange rate and consumption growth, conditional on the level of interest rates. That's the key difference. It's a very good question. Nick?
I think you can probably keep going for now because I think that'll address some of the questions.
Okay, so I'm going to go for another benchmark, but now one that comes with a very big assumption. So I'll need to go slowly on the assumption. So I'm going to assume that markets are complete. Just in case you have any doubt on what I mean by that, let me just go very, very slowly here. I'm going to assume that there are S states tomorrow, and for every state, there is a contingent claim that pays 1 if that state is realized. Now, if you make that assumption, which we all know it's wrong, okay, we all know it's wrong, but still it's a very convenient way to think about the world. It's a benchmark. If you make that assumption, you know what the price of an asset is. It depends on the payoff of that asset in every state times the price of the contingent claim for that state. So that's a simple definition of the price of an asset. So this assumes that you know what the price of this contingent claim is. You can rewrite it by multiplying and dividing by probability, and you have the usual thing that looks like an Euler equation. The price of a payoff X is E of MX, where you can define M as those weighted prices of the contingent claims. Like, you know, there is a link obviously with the risk neutral probabilities and the way people tend to think in the industry. Now, you can derive this equation like this. You can also derive it through a simple maximization problem, like the classic Euler equation of an investor with maximizing consumption today and the expected consumption tomorrow. And that investor, he or she, can decide to buy an asset, price PT, quantity Xi, and think about what is going to be the consumption tomorrow. And the consumption tomorrow is going to be equal to the endowment tomorrow, QT plus 1, plus whatever payoff I get from that asset, XT plus 1. Do you look at them, take the first order condition, and you're going to derive the classic Euler equation I have here. Now, you see there are two ways to think about the existence of this Euler or Euler-like equation, E of MR equals 1. And this can be extremely, extremely powerful in international finance. So let me show you this in the most simple way I know. Let's think about a foreign asset with return R star. That asset can be bought by the foreign investor, which is why I have this first order equation, E of M star R star equals 1. But if that same asset with return R star can be bought by the US investor with a stochastic income factor MT plus 1, there must be another order equation. And what do I need in order to build this order equation? I just need to convert this return into what it means in terms of the unit of the US stochastic income factor, which is why here I have the change in the real exchange rates. So change in real exchange rate, of course, is built directly out of the nominal one using the ratio of the two price indices. Now, why is it important to write those two order equations? Well, because if markets are complete, there's only one way to price an asset. You remember, it's the price of those contingent claims, that's it, right? And so it must be that the change in exchange rate is related to the two stochastic discount factors. And so you can write it in logs. The delta QT plus 1 is the log difference between the US stochastic discount factor, MT plus 1, minus the foreign stochastic discount factor, M star T plus 1. And this, you can think of it as an accounting definition. It doesn't say anything about causality. It's not the case that M causes Q or Q causes M. No, it has to hold. It has to hold because you assume that markets are complete. Now you notice that here I'm in expressing everything in terms of real exchange rates. Since I'm going to look at the excess return, the truth is that it doesn't matter much. You can write down an currency excess return in terms of nominal variables, as I did before, or in terms of real variables. And of course, you get pretty much the same thing because the inflation shows up both on the interest rates and on the change in exchange rates. Now, I want to show you one or two classic results here that are going to be very useful, I think, to understand a big chunk of the literature. First, if we have an order equation, well, we have the same classic result as before. For any other asset, if I can think about the excess return as being the product of a price of risk and a quantity of risk. And so each time we see an excess return on currency markets, we need to understand the covariance. What is the quantity of risk? Can we measure it? That's basically the same thing we would do for any bond or equity returns, of course. And the intuition is exactly the same. The expected excess return have to compensate investors for low returns in bad times. So the whole discussion is then how you measure bad times. And so I gave you two examples before, either low consumption growth or high equity volatility, but there are other ways to do this because maybe there are different kinds of investors and we have better measures of bad times. And the more research you do, the better we're going to measure those bad times. But the logic stays the same. If I make money by investing in high interest rate currencies, it has to be that those high interest rate currencies are going to depreciate in bad times. Okay. Now, there's a very cute result that goes back to Beckert in 96 and Benson in 97. But you get in 2 lines of math by adding one assumption. And this assumption is that the world is log normal. And so, okay, we made 2 assumptions at this point. Markets are complete and the world is log normal. Those 2 assumptions are, again, wrong, but they give us an easy way to think about exchange rates. So if the world is log normal, you can very easily write down the short-term interest rates, risk-free rate at home, RT and R star, in terms of the first and second moment of the log SDF, log stochastic income factor. Now, you still have this definition of the exchange rate as a ratio of the 2 stochastic income factors or a difference in logs. So you can use the 2 results before to derive the last line of this slide, which is very useful to build intuition. The expected excess return, again, by borrowing in the US at the risk-free rate, investing abroad at the risk-free rate, and taking on the exchange rate risk, is equal to the differences in the variances of the log stochastic income factor at home and abroad. Well, if you write down the model where those differences are 0 or each one is 0, there's no way you can explain the risk premium. And that sounds like completely obvious, but you can revisit a big chunk of the literature and through the lenses of this equation, you see that it could not work. There was no way that you could explain large currency excess return. Now, I think this gives you the conditions, the necessary conditions you need in all those complete market models. You need SDF, stochastic income factors, that are very volatile, and you need differences across countries. Now, it might look a bit strange to not have a covariance term. Usually when we think about an excess return, it's about a covariance between the stochastic income factor and the returns. That's just because we look at expected log excess return. If you just look at the expected return in level, You just add the Jensen term, and you can rewrite the right-hand side. It's going to show up again as a covariance between M and the change in exchange rate. So the logic is really the one I said before. I should expect a positive excess return if I invest in a currency that's going to depreciate in bad times for me when it hurts. So that's really the logic. Now, you remember this cute result also from the log normal world, where the maximal Sharpe ratio is equal to the standard deviation of log SDF. So if we want to explain, if we want to have models that are not at odds with the data, now that we know that they are all large currency excess returns, we need models where stochastic factors are very volatile. It has to be. We need big Sharpe ratios. Stochastic factors have to be volatile. And the second thing you see again, I say it again because it's important, we need large differences across countries. Because if the stochastic factor is as volatile in the US as in the UK, you're not going to get any kind of excess return. Right? So these are kind of simple conditions that we need to satisfy. And you can actually go back to the different papers written over the last 10 years or so. And with the exception of one I'll mention, you can look at those papers through the lenses of this simple equation. Do they produce volatile SDF? Yes. Through habits, through long-run risk, for disaster risk, they produce volatile SDFs. Why do SDFs differ across countries? Then the story is going to be different across those different papers, right? The paper that actually, all the papers that you can understand with this frameworks, all the papers are actually assume that markets are complete. In the GABEX and majority paper, markets are not complete, so you cannot use the same trade. But I think this is a very, very natural starting point, and I think there's a lot that we can learn using this simple assumption. And we can all agree that markets are incomplete. There's no problem with that. The question is how much you get by studying market incompleteness. So some people can study that, and others can just make this very strong assumption that markets are complete, which is like saying, okay, there must be some frictions in terms of tradings in goods, but I'm going to ignore the frictions on the asset side, and I'm going to proceed. Now, if you do this, you have a very powerful tool. Come up now with a reason for why there is an equity premium in a given country. Another way to say it, come up for a reason why the SDF is volatile, and now you can extend it to a second country and see what you have to say about the world. I think this is a very promising way to go. It's also a relatively easy way to close a model, because you write down a model for a country, think about the optimal behavior in that country, do the same thing in another country, then assume that markets, financial markets are complete, and you add what the exchange rate is. It just in one equation, just a ratio of two SDFs. So that's it, right? So that's, I think, again, it's just a benchmark, but it's one way to go. Now, if we take this benchmark, we still have very difficult questions to answer, and I don't know the answers to those questions, right? Why are SDFs moving differently in different countries? If you assume that markets are complete, you're saying that there's not much friction on the asset side. But if there's no friction on the good side either, then the real exchange rate is going to be 1. There's nothing interesting to study. So there must be some interesting friction on the good side, and we need to think about why they move SDFs differently across countries. Now, you can also revisit everything you've learned on equity and bonds, right? We usually think that what matters are the systematic shocks, because the idiosyncratic shocks average out in portfolios. Well, the same logic applies here. But what are the idiosyncratic shocks? What are the global shocks? Where do they come from? This is, again, an avenue of research in itself. So the key frictions that prevent perfect reshoring and that move the real exchange rate, what are there? It's absolutely not obvious. And leaving the realm of the models, if you just go to very simple, down-to-earth analysis, how do countries share risk in practice? It's one thing to write down a set of contingent claims, but in practice, what do people buy? Who is actually sharing risk across countries? There's a very interesting work in international econ on that, but to link this work and to go beyond that and to link it to international finance, there's again an avenue of research there. Now, of course, I only shown you one or two risk premium. There are many other ways to go, and they actually may come with a different explanation and different assumption. The reason I brought up this complete market framework is because it forces you to always think about volatility and covariances between stochastics and factors. So maybe I should stop here again. I have more, but let me stop here again. I'm at the end of my first part, but I'm willing to stop before going on the second part. Nick, should I answer my questions?
Yes. Yeah, we have one question from Alessandro, but Nick indicated he plans to talk about it at the end. So then let's move to the question by Son Young Kim again. So the question is like Sandulescu, Troiani, and Verdelhan argue that the asset market view real exchange rate is difference in log SDFs can even hold in special cases when markets are incomplete but integrated. Since developed markets are highly integrated, can the asset market view still be approximately true in this setting?
Yes, that's a very good point. I didn't go there. You can make the point that you can define the exchange rates not just by looking at the ratio to SDF, but looking at their projections on the set of traded assets. So it's a slightly, maybe slightly more complicated approach, but it's, yes, we can relax. I made this very strong assumption. We can relax it and have still a very interesting definition of the exchange rates. It's a very good point. Yes.
That's it for the questions for now.
Nick, do you want me to answer?
I think there's another question from Chang. Chang, do you want to? Well, I can read it out actually.
Okay.
When markets are, I guess that's a comment on the previous question. When markets are incomplete, one thing we need to take a stand on is the available asset menus. For example, the recent paper by Camanio, Howe, and Ray treats exchange rates to be determined by equity flows. We may also think debt flows matter. Can you comment on what kind of stand you prefer? Do they matter and how? If a model result relies heavily on the asset market structure, is that a good thing or a bad thing?
That's a very good question. So let me just take a step back just to make sure everybody understands. By assuming complete markets, you take a very strong stance on what happens on financial assets. Yeah, all those contingent claims have to exist, right? Or have to be built. So that's clearly a simplification. So very naturally, we want to go beyond that assumption. The question is how? Where do we put the frictions? We thought that the natural first step, we meaning Hanno and I, thought that the natural first step would be to restrict the set of assets that people can trade. Instead of assuming that they can trade all those contingent claims, let's assume that they can trade only a few assets. And to go really to the extreme, we assume that they could trade only treasury bills. Treasury bills at home, treasury bills abroad, and assume that they can't trade anything else. So that's a very, very segmented market view of the world, if you want. One way to make progress on that is actually to use results from Bacchus, Renzi, and Talma, and to think about the exchange rate not just as the ratio of the two SDF, as I showed you in complete market, but the same ratio times some wedge, and the wedge comes from the market incompleteness. Now, even but assuming that people can only trade treasury bills and at home and abroad, we got into very serious trouble when we tried to explain both the volatility of exchange rates, its co-movement with any kind of reasonable SDF, or the risk premium behavior. So that's a paper that Hanno and I wrote 2 years ago. You'll see, it's not easy. As soon as people can trade, even just treasury bills, the same big puzzles that we have to face that I described today still arise. So I think a more kind of, my favorite, but now I'm not proving it, I'm just saying what my favorite approach is, if we go beyond the complete market assumption, is to go for a segmentation, not in terms of assets traded, but in terms of who has access to the markets. I think the average Joe in the US doesn't really invest abroad and doesn't have much of an impact on the exchange rates. So segmenting, not in terms of assets traded, but who has access to the market, that seems to be a very promising research avenue.
I think this is probably fine for now. I think you can move on to the next topic if you feel like. I think we're pretty much covered all the questions so far, but everybody should feel free to, again, raise your hand if you want to ask a question now before Adrien moves to the next section of his talk.
Yes, I went fast, so we can take the time. These are really good questions.
Do, please. I don't think we can hear you. So perhaps you can put your question in the chat window. And in the meantime, Adrien, I think you should keep on going. Okay,
so I'm going to do that. But I'm totally happy to revisit this link between exchange rates and aggregate risk, and I'll do it anyway. You'll see that the two topics interact in the end. So I'm going to talk now about something that I found very puzzling, is the fact that we can see exchange rate returns and excess returns even without risk. And that should not be there, right? We all know that this is a bit exceptional. And so that's what I want to show you. It goes back not to 1740 this time, but to 1923. It's Keynes, in the Tract of Monetary Reform, explained to the world what is a forward rate. And it's an explanation that is so clear and so beautiful. It's now in every textbook. So I'm just going to go over it if you've not seen it before. It's the story behind the covered interest rate parity. So the first part of the talk started out of the uncovered interest rate parity. Now I'm going for the covered interest rate parity. So bear with me. Just do the following thought experiment. Borrow $1 at the US dollar risk-free rate. Same notation as before, IT. Now you can exchange that dollar for ST units of foreign currency, let's say yen, 100 or so yen. Okay. Now you can invest at the foreign risk-free rate, so still at the Japanese yen risk-free rate, I star. If you just do that, this is what we described for the previous 50 minutes or so, right? You're taking on the currency risk, and if the yen appreciates, good for you. If the yen depreciates, that's pretty bad. Now, let's imagine you don't want to take the currency risk, and instead, you want to hedge it. What you can do at the beginning of the investment, beginning of the month, you can sign a forward contract that basically determines how many dollars you would get per yen at the end of the month. And so this forward rate, FT, is going to convert back the yen into US dollar. Now, what Keynes explained in 1923 seems very, very convincing. If you do that, you're not taking any risk. Everything is decided today. You know the spot rate today, you know the interest rate in the US, you know the interest rate in Japan, you know the forward rate. Everything is known today. There's no risk, so there shouldn't be any profit. So the amount of money you need to reimburse is 1 plus domestic interest rate. That's the left-hand side of my equation. And what's the amount of money that you're going to make? Well, you're going to make money by investing 1 plus I star ST yen in Japan, and you're going to convert it back at the FT rate. So that's going to be an amount in dollars. So what you have to reimburse should be exactly equal to the amount of money you make. And that's basically how forward rates were built for many, many years before Keynes and after Keynes, right? Now, it's the benchmark. It's in every undergraduate and graduate textbook. It's not really peanuts. It's not something that you just learn for the fun. It's actually really the building block of very, very big markets, building blocks both the forward and the swap markets. In the national outstanding, 61 trillion, trading volume, $3 trillion per day again. These are really, really big market, and they all were built because we could understand what was going on. Now, if you want to be more precise, you also have to take into account transaction costs. You know that there are bid-ask spreads on currency markets like in any other market. And so what you want maybe is not something that looks like in inequality, but two conditions. And what do those two conditions mean? Intuitively, it's just the idea that you cannot borrow in the US and invest abroad, take out the risk and make money. In the same way, you cannot borrow abroad invest in the US, take out the currency risk, and make money. It's just not possible. And that's why you have those two simple conditions. And those conditions for a long time seem to hold very well. Now, of course, if I'm talking about this, it's because they don't no longer hold, right? So you need to introduce some deviation from this simple condition. And here I'm putting it on the right-hand side. This is just by convention. There's no reason you can put it on the left-hand side if you want. Now, the deviation from covered interest rate parity in this framework have a simple intuition. You can look at the interest rate IT that you would have to pay if you were to borrow in the US, and look at how much it differs from another way to fund yourself, where you would borrow in a foreign country at an interest rate I star, and you would get rid of the exchange rate risk by hedging it. And this would be, if you want a synthetic way to borrow US dollars, you would borrow in a foreign currency and take out the currency risk. The logic of Keynes was you should be the same. These are two ways to obtain $1. We should have the same cost. And of course, I'm going to show you that it's not the case. Right? So for a long time, apart for some very small episodes during a large crisis, the CIP condition held very, very well. So what I'm showing you on this graph is a little XT that I had on the previous slide, which is the difference between the direct interest rates and this synthetic interest rate. So it should be 0 according to the CIP condition. I'm showing you things in basis point, on top of it annualized. So as you can see, it was pretty much 0 until the crisis. And after the crisis, it's not. Now, very clearly, there are two parts. The first, during the crisis, there are clear deviation from the CIP condition. And you can see, again, deviation from the CIP condition over the recent crisis. In some sense, that is not too surprising. There are many arbitrage conditions that didn't hold during the crisis. People are scrambling for money. There are opportunities to make money if you do have money when nobody has. The most surprising thing is that after the crisis, those CIP deviations still exist. And that is troubling. What is going on? This is, as I told you, it's one of the biggest, if not the biggest market in the world. CIP deviation should be 0. They were 0 before the crisis. After the crisis, we should go back to 0. And clearly we did not, right? So for the fun, I also did here the same thing I did for the currency returns. I looked at what happened today, just to make sure that I'm not telling you should work on something that disappeared. And so here I'm showing you the same thing, the same kind of CIP deviation, but for convenience measured out of the cross-currency basis swap. I won't get into the details. You can think of the same objects, the difference between an interest rate in US dollar and an interest rate in a foreign currency after taking out the currency rates. So in basis point, again, this difference should be 0. It was pretty much 0. Look at the scale. Again, everything here is annualized before the crisis. During the crisis, not. After the crisis, those deviations are actually sometimes bigger than what they were during the crisis. So this is a major puzzle. Again, it should not be there. All those CIP deviations should be 0. Clearly, they are not. And if you want to see what happened during the last few months, you have it there. Of course, they did not disappear at all. They actually even blew up a little bit more in March this year. So this is something really big that we need to understand. And clearly, there is before and after. So any kind of a story we're gonna entertain or we're gonna suggest to understand this, we need to explain why the CIP deviation was 0 before and it's so big now. Now, why is it something that we should explain? Well, it's because there are arbitrage opportunities. So we can also decide not to explain and just go and try to become rich. So let me explain why there is an arbitrage. Here, you need to go a little bit into the detail of the trade. So I'm going to take the example of the Japanese yen. The Japanese yen has a negative basis, the way I defined it, with respect to the US dollar. So think about how you would make money. It's going to tell us what kind of research we should do. So imagine I am a US based arbitrager. What I'm going to find is I'm going to find someone who's going to lend me $1. With that dollar, I'm going to immediately convert it into yen, and I'm going to find a yen borrower willing to borrow from me. Now, what's going to happen at the end of, that's the beginning of the month. What's going to happen at the end of the month? At the end of the month, my Japanese borrower is going to give me back some yen with some interest attached to it. That's a good thing. The problem is that as a USD arbitrager, I need to reimburse dollars, right? So I'm going to, at the beginning of the month, I'm going to sign a contract with the forward dealer. And that contract is going to say, dear forward dealer, when I'm going to give you that amount of yen, you're going to give me the same, the equivalent amount in US dollar. And that's going to help me reimburse my debt. Now, if you look at what's coming out of that, is actually a profit for sure, that is equal to minus 60, but since 60 is negative for the Japanese yen, it's actually a positive profit. So once you look at this, there are many things that can go wrong in this arbitrage strategy. First, maybe there are very big transaction costs, both on the bond market when I borrow and lend, or on the currency markets when I trade at the spot or the forward market. The truth is that those transaction costs seem to be relatively small. So it's going to be very difficult to explain the very large CIP deviation I showed you before. But there are other issues. For example, what if you sign a contract with a forward dealer to change, swap yen for dollars at the end of the month, and if this forward dealer is not there, you're in trouble. Now, this is a very natural concern, but markets are pretty well organized, and there are ways to address it, as you know, and I'm not sure that's going to explain much, but maybe we should study that more. Now, there are other things that can go wrong in this arbitrage. The problem is whether the risk is big enough to justify the very large standard deviation, the very large, arbitrage opportunity we saw. Just to show you the magnitude again, we are talking about 50 basis points, and they don't disappear. It's not like you don't have time to wake up and the thing is gone. It's not something about the millisecond. It's something that persists. It's something that's been around for 10 years now. So if you think about any kind of market friction, you would need also to think about why this market friction cannot be overcome in order to go after this arbitrage opportunities. And that, of course, raises the bar. Okay. So what we did, I can tell you what I know about this, and this is my my take on it. There are other reasons. The other reason for why this CIP deviation exists, and this is just one of them, but I think it's part of the story. And the story here is about what the banks are doing, and why the banks today are not the same thing as the banks before the crisis. And the main difference is that we really changed the regulations on those banks. And I'm actually not against this. I think it's a really good idea, but we have to recognize that it has also implications for the way banks work. And so let me just explain both this graph and the logic behind. Think about a German bank or a European bank, for example. That bank has to report its balance sheet at the end of every quarter. It's as if the regulator or the general public would just take a snapshot of the balance sheet of that bank at the end of the quarter. For a US bank, it's a little bit more complicated in the sense that what the US bank has to report is not just the balance sheet at the end of the quarter, but also an average of the daily position. So let's focus for now on the European banks because it's just easier to think about it. Now, imagine you are this European banker and you know that you have to report your balance sheet at the end of the quarter, and you know that the bigger the balance sheet, the bigger the cost imposed by the regulators. So that's certainly going to have some implication how you behave. At the same time, you also know that there is this really cool arbitrage opportunity where you can really make money without taking any risk. It's very tempting. It's difficult not to go after that. So you're going to go after that. You're going to do it. And so let's say that, for example, today, August 11th, we see an arbitrage opportunity. We see that we can borrow money for 1 week in the US lend money for 1 week in Japan, and buy a 1 week forward contract. If we do this, the position is closed 1 week from now, so 7 days from now. And so the regulator won't know. Nobody will know. And we're just going to go after this arbitrage opportunity because it's there and because it doesn't entail any additional cost. I oversimplify a little bit, but to explain. Now, imagine what happens when you enter the last week of the quarter. So you're going closer and closer to the end of September. The last week of September, now it's a very different problem, right? Because the arbitrage opportunity is still there maybe, but if you do the trade, you borrow in the US, you invest in Japan, you buy this forward contract to hedge your currency risk, the size of your balance sheet goes up. And so that trade now becomes costly, actually costlier for you than before. So what would you expect? What you would expect is that the size of the arbitrage opportunity tends to increase when we reach the last week of the quarter, because a lot of big banks are going to say, no, I don't want to trade anymore. It's just too costly for me to do that. And so if nobody trades, then the arbitrage opportunity is going to become bigger. Now, if you think about what should happen at the 1 month horizon, thinking about the 1 month forward rate, it's going to be the same. But the key point is not going to be the last week of the quarter. It's going to be when you enter the last month of the quarter. So right now, if I trade a 1 month forward contract, I open the position now, I close the position 1 month from now in September 11, nobody knows that. But of course, when I'm going to reach the end of August, the world is going to change. Because if I open a 1 month forward contract position on September 1st, this is going to show up at the end of September, and thus will show up when the snapshot of my balance sheet is taken. So now we can look at this graph, and you're going to see immediately what this is about. The red line is the 1 week CIP deviation on the yen versus US dollar in absolute value. So it's not negative or positive. And what you see is that it spikes exactly when we enter the last week of each quarter. And on this graph, it shows up as the blue bars, right? So the CIP deviations exist, and then they spike during the last week of the quarter. If you look at the 1 month CIP deviation, now you have to look at the green line, and you see that it spikes exactly when you enter the last month of the quarter. So basically what you see here is what our corporate finance colleagues do, right? It's a diff in diff. You can compare the 1 month contract versus the 1 week contract. You can have, if you want, a 3 month contract as a baseline, a non-treated contract, because a 3 month contract always has to be reported on a balance sheet. And what you see is the diff in diff is going to help us establish causality. And what we see here is an example of where the behavior of a financial intermediary, the bank, has an effect on asset prices. Mm-hmm. Now, what is important here to notice is that the quarter end is important because that's when the banks need to report. But the identification doesn't come out of the quarter end. It comes at what happens 1 week before, when you look at the 1 week forward contract, or 1 month before when you look at the 1 month forward contract. Because we all agree that at the quarter end, many different things happen. Someone mentioned the work of Ho and Ray. They had a previous paper where they showed at the end of the quarter, all those mutual funds rebalance on the equity markets. So that could have some implication for what's going on the currency markets. That's what they showed. So this is not about what happens at the end of the quarter. It's what happens 1 month before or 1 week before, depending on the contract. And so that's kind of a sign that all of this literature on intermediary-based asset pricing, well, I think they are all right. It has been very difficult to show that intermediaries matter. At a very high level, you could think of the following experiment. In 2008, 2009, the stock market goes down and the banks are in trouble. What is driving what? Are banks in trouble because the stock market is going down, or the opposite? Here, you can resolve this reverse causality and a middle variable issue by having a simple definitive, triple definitive actually, because you can compare what happens before and after the regulation, when the regulation really kicked in 2015. So that's a simple way to think about this. And that's why actually this graph actually changed the way, changed my research and think about what I should work on. And I'm not completely convinced that we need to understand what financial intermediaries are doing and the impact on the markets, even on something that is the biggest market in the world, right? So I wanted to do this for this graph, the same thing I did for the rest, show you that it's still there. So if you want to study it, it has not disappeared. First, of course, the lab is still there. We can study the past, but those the deviation and those spikes, they are still there, still at the end of the quarter. They're sometimes even bigger than what we said in the paper with Wang Xin, particularly at the end of the year. There is a lot, a lot that we need to understand. So before going for a list of potential research topics, I want to tell you why we should care. And this is just a partial list, but why we should care. There is a view that you may have heard that actually we don't care. We don't care because FX derivatives are a zero-sum game. So it's basically Goldman Sachs making money out of JP Morgan or the other way around, and who cares, right? Fine, we do this every day. There's another view why we don't care. It's the idea that maybe the cost of hedging, the cost of every forward contract has gone up, but it's because now you have a better contract. Before, banks were selling those contracts, but you were not sure they were not going bankrupt. Think about Lehman, but now you know they're not going bankrupt, so this is a better product, so that's why you should pay more. Okay, these are good arguments, possible. You can also view this as, you have to be even US-centric, view this as a kind of a measure of the monopolistic rent of having access to US dollar, and Nick is going to talk about how the US dollar is special, and so if you have access to US dollar, somehow you enjoy this rent, and maybe it's all good, at least as long as you're a US bank. But you can have a more anxious view, right? And the more anxious view could be the following. This, as I showed you at the beginning, it's one of the largest and most liquid markets in the world. If you find an arbitrage opportunity in the most liquid market in the world, then there should exist many, many, many more elsewhere. It's just that we don't have the tools to define them so precisely. We need assumptions, and so we're not totally sure that there are arbitrage opportunities. But of course, if they're there, there's no reason they are not elsewhere. Now, there's another reason why you should be a little bit anxious. Each time you change the price, it should affect the behavior of agents. And here we're changing the cost of hedging. If we change the cost of hedging, some people are going to hedge less. And you can already see this actually among Japanese institutions. Some decided not to hedge anymore. That, I think, is a bomb waiting to explode. Now, there's another more pessimistic view, is that if somehow banks can no longer arbitrage this market away as they used to do it, then they're not doing so well. And if they're not doing so well, maybe the next big shock, they'll be in deep trouble. And so, of course, the next big shock is already there, and we're going to see a big wave of bankruptcies, and you wonder how the banks are going to weather it. Okay. Now, honestly, I don't have a strong view whether this is benign or anxious. When I see the CIP deviations, I just have an enthusiastic view, which is like, whoa, that's so cool. We've been talking and writing about models with frictions, but it was always difficult to test those models. Here we can. It's like, this is the academic dream. In some sense, there's no asset pricing model that can explain this without a friction. Like, it should not be there. So it has to be about frictions. Now let's test those different frictions. Think about which one is the most important one, and let's go for it. We have now the data to test this. This is the cleanest data we can think of. So to me, this is just pure excitement. This is really, really cool. I want to now link the two topics I mentioned, the carry trade with currency risk and the CIP deviation, to show you that there is a link, and that I'm going to offer more actually topics for research. Don't worry, I know that I only have 5 minutes, but I don't need more. So I can think about the currency excess return by borrowing in the US at the US risk rate, IT, investing at the foreign risk rate, I star. That's how I presented at the beginning. But there is another way to implement it, and that's what we did with in the paper with Hanno and Nick. Think about buying a forward contract, not as a way to hedge, but as a way to take currency risk. So buy a forward contract at date FT. This is a promise to receive maybe some yen at the end of the month and convert those yen into US dollar. You have here an excess return. You can use the CIP deviation to just show how this relates to the interest rate difference and the change in exchange rates. But if there are CIP deviation, the little XT that I showed you before, you can see that there is a difference between implementing a currency return strategy on the forward market and implementing it on the treasury bill market, on the bond market, right? So it turns out that actually the carry trade is even more profitable on the forward than on the cash market, because for high interest rate currencies, the little XT, the little CIP deviation is actually positive. So there is a link between those two, and I'm going to show you one more thing about it. But before I go for there, let me just make sure that we have the right orders of magnitude. The CIP deviation I showed you are around 50 basis points annualized. But the currency excess return I showed you in the first part of the talk are 10 times bigger, 500 basis points, right? So we're not talking about the same magnitude. It's not like one is canceling the other. These are two different objects, and those two different objects are clearly related. Let me show you one more graph. These are the CIP deviations on average, very long sample, but sorted on the level of short-term interest rates in different countries. And what you see is that the CIP deviations are negative for low interest rate countries and positive for high interest rate countries. And this cannot be random. When you have a graph like this, there is something deeper that is going on, and we need to understand that. And I don't pretend that I have the perfect story for that. So let me not even try. Now, if I think about the again, a series of directions for future research, since that's what was the goal of this talk. I think we can go back to what I said before. Do we have new risk factors? Can we link those risk factors to some kind of micro liquidity or macro shock? What are the differences across countries that make the SDF volatile? These are really important questions. But I think what would be really cool is now that we have tools, we have things to measure on currency markets that are not random, then maybe we can link back exchange rates to monetary and fiscal policies, linked to term structure, things that we kind of, maybe the previous generations kind of gave up because there was nothing. I think now we can revisit all those questions and go very interesting work on this. Here I mentioned the Currenci and Vianos and Greenwood and Stein Sundaram paper, but there are others. There are also fundamental questions that people worked on, but something like 30 years ago. The optimal currency hedging was a really cool paper by Black, but it's a long time ago. Maybe we can revisit those kind of questions, fundamental questions, using what we've learned. And I think this is also pushing us, particularly the CIP evidence, toward intermediary-based asset pricing. And there is ongoing work on that. And here I'm just citing some of it, and some of it just on the currency part. There's much more outside the currency market. But we need to find what is the key friction. This is not obvious. There are many things that are moving at the same time. It's not easy to find what's the key friction. Once we know, we need to understand how to model it. And clearly here, I forget the very interesting works by Gerald Dolphy and others, for example. Now, once we see that there's something interesting to study both in the time series of the CIP deviation and the cross-section, this link with interest rates, of course, I think we want to see the link between what's going on in currency markets and what's going on in terms of monetary policies, whether the classic short-term interest rates or the more recent QE experiments, right? So I'm going to stop here. The last thing I want to mention is the one that actually Nick is going to start with, is this idea that there seems to be a special role for safe assets, and particularly the ones that are denominated in US dollars. It's kind of a super hot topic right now. And it's a way to actually think about both the CIP evidence and the UIP deviations. There is something special about the US dollar that we can study in those frameworks. I should stop here and take questions.
Yes.
Or maybe shut up. I can do that.
We have a few more questions. So the first one is from Nobuhiro Abe. Could you please let us know your interpretation for the difference of the direction of the deviation in CIP between Japanese yen and Australian dollar? Is there any consensus regarding this in academia?
That's a very good question too. So let me maybe go back to this graph. If you want to make money on the carry trade, you're gonna borrow in Japanese yen and invest in New Zealand dollar and take on the currency risk. And on average, you're gonna make money because you're gonna lose money in bad times. If you wanna make money out of the CIP deviation, it's the opposite. Instead of borrowing in yen, you lend in yen and you borrow in New Zealand dollar and then hedge the currency risk. So it's very interesting that you have to take the opposite position, but clearly there is a link between the two. So how can we think about that? Maybe one intuition that when she told me is the following. Think about all those Japanese institutions. They face a very low interest rate. They would like to invest in the US, maybe in the US bond or corporate bond markets, but the exchange rate is very volatile. So they want to hedge the exchange rate risk. And so they go to a bank, one of those big investment banks in the world, and the investment bank said, yeah, I'm going to sell you the forward contract you want to hedge the currency risk of the US dollar, but I'm going to charge you a premium because it costs me something to do so. And so here you can see why there could be a link between a portfolio investment decision from a low interest rate country investing in a high interest rate country and the cost of hedging, which shows up as a deviation from the CIP. This is just one way to think about the question that I was asked. This is a very good question. I don't have the full answer. Those differences in CIP deviations are very interesting. The intermediary-based asset pricing and the friction that I highlighted cannot explain differences in the level of the CIP deviation. There must be some hedging demand that is very different in one country versus another. So it's a very good question. And I must admit, I don't have the answer.
Okay, the next question is actually from Nina. Was there any interesting behavior in the 1 week CIP deviations in the end of the quarter before 2008? Were the reporting requirements different then?
It's a very good question. The reporting requirements were different. The reporting requirements really changed in 2015 for those European banks, and actually all the banks. The rule is just stricter for the European banks. But before 2008, we didn't have the same rules and we didn't have the same requirements. Yes.
Okay.
2015 is the date to keep in mind. January 2015.
So before 2015, there were no jumps at the end of the quarters for the CIP deviations?
No, very small, very small. You see almost nothing, yes. So to be clear, before 2008, you see very little CIP deviations, except during a very strong crisis like the LTCM crisis in '98. And between 2008 and 2015, the end of quarter thing really becomes big after 2015. So you have CIP deviations, but yeah, the end of quarter thing is only after 2015. It's particularly clear. And when you run a regression, it's extremely significant. The post 2015, then it's a very good point.
Is that driven by the U.S. regulation taking effect or European regulation taking effect? I mean, there were changes. There was.
I don't know. Both. I don't know because the thing is that the Basel regulations are supposed to apply everywhere. It's very. We haven't found a way to disentangle both. It's a very good point. Yes.
Okay. The next question is again by Sun Young Kim. It seems to me that the CIP deviations are tied to the fact that banks are marginal in FX markets. If this were to change, for instance, due to financial innovation, such that the marginal investor shifts to more retail style investors, for instance, like algorithmic traders, would we expect these CIP deviations to disappear over time? Essentially, banking regulations are unlikely to matter for these kinds of investors.
Oh, this is again a very good point, because I only talked about banks, but a very natural point to raise is like, what are the hedge funds doing? Why don't they borrow money and go after this arbitrage opportunity? And so the question, in some sense, is also in this direction. Maybe some markets are going to evolve so that banks are no longer the main players, and those markets are not the marginal ones. And then we should expect the CIP deviations to decrease. I totally agree with this logic. The thing is that I talked to some hedge funds, and when you tell them that they can make, after transaction costs, something like 20 basis points per year, they are not excited. This is nothing. If you can lever it up 10 times or 20 times, then maybe we can talk, right? But the problem for them is how to lever it up. You need someone to borrow from. And so a hedge fund is can go to its prime broker or kind of a bank and say, look, this is the strategy I would like to play. Can you lend me a lot of money at the end of the quarter? And the bank is going to say no. Or the bank is going to charge them an interest rate that is so high that it can basically eats up all the CIP profits. Because of course the banks can do it themselves. Right? They just don't need the hedge fund to do that. So I think that may explain why the hedge funds have not been able to get those CIP deviations to completely disappear. Now, the question that I was raised is a very good one. If market changes, the microstructure changes, we could have more people going after this. And I think it's a very natural thing to expect. Honestly, if right now you're a treasurer of a big company, you're CFO of big companies, take Apple, GE or whatever, you're sitting on billions of US dollars. Why not just go and enjoy this opportunity? And some of them do. And I expect this. I think what the question raises is also very interesting in the following sense. It forces us to think about the microstructure of the market and how this can have implications both on the CIP deviations and on the risk-return trade-off. This is a very good point. There is no reason why those two literature should go in opposite directions. Yes.
I actually have a related question to this. So even if banks operating in these markets, they know that there's going to be this spike towards the end of the quarter. So why don't they close out their positions just like 1 week earlier at like way better conditions?
That's exactly what they do. That's exactly what they do. So I can't tell you exactly who is doing that because I promised you not to repeat it, but that's exactly what they do. Yes. Think about really big banks in the US and abroad, and at the end of December or some days before, they just say, no, we're no longer going to trade. Let's stop. It's not worth it. So yes, it's a good point. That's exactly what we do.
Okay, cool. And the next question is by Luke Min. It's also related. In light of our previous comment on your preferred approach, let's think about who has access to which markets. Could you say more about the type of agents that have access to the arbitrage trades that would close the CIP gap? Are they mostly banks? Where are the hedge funds? We already covered that. What kind of access to capital do they need to execute the trade?
That's a good question. I don't think I have the answer to that one, honestly. Yeah, it's a very good question. It seems that you don't need much actually to go after this arbitrage opportunity. But if you want to do it properly, so let me explain. It's actually a very good opportunity to explain a little bit. Where is the risk in this arbitrage opportunity? Well, the risk is, I don't think it's in signing a forward contract or in mismeasuring transaction costs, but you can really see that on your Bloomberg screen, and the forward contracts are very well written. The risk is in lending your money. You're lending your money to, just to use my example again, you're lending your money to this Japanese borrower. What if he or she doesn't pay back? So you need to find a way to lend your money really risk-free. And so in the paper with Wang Xin, what we did is that we looked at repo rates, where you lend your money, but you get some really serious collateral. I think for anyone to implement this strategy, you can do it in a cheap way, taking on some default risk, but then it's no longer a big surprise that you're making money. It's like you could just do the same thing by lending your money to a US firm. If you really want to go after the arbitrage opportunity, you need to convince yourself that you're lending your money to some Japanese borrower without taking any default risk. And that's much more difficult. And then if we think about who really can do this, I think you have to be a financial institution. The best investment I could think in Japan would be to lend money to the central bank. I cannot do this myself. You have to be an institution. So I think that's where the limit is. So to answer the question more clearly, if you want to implement a kind of a dirty version of the CIP deviation, I think we can all do it with just an E-Trade account. Like everybody can do it. But I think you're going to take on some default risk. If you want to do it in a very pure way, and the way we would write it in an academic paper, I think at this point you have to be a financial institution because you need a bunch of agreements, kind of master swap agreements, but only the pros have.
Great. The next question is by Alessandro Ribucci. One important thing is that this is not a unified market, although linked to the plumbing of the US financial system that has had troubles functioning properly.
Yeah, that's a very good point. A very good point too. I think we need to study this plumbing. The plumbing is not a dirty word. It used to be that we only want to think about the big questions like risk sharing or that. No. Let's study the plumbing. Let's understand exactly what are those frictions. And we're going to learn something about the exchange rates this way. So I completely agree with this point. And now there are some frictions that are easier to spot than others. The question mentions managed floats and all the kind of trading restrictions that some governments impose. I think we should study those for sure, because in some countries they really matter. Like if you think about Brazil, you cannot avoid that. But even in a country like the US, it's not like trading is so free and there are no frictions to study. So yeah, I do believe that we should study this. It's a very good point. It's no longer a dirty word. Yes, we should study the plumbing.
There's one last question by Dong Fang. How does central bank intervention affect currency risk premia? Some countries have crawling pegs, some manage floatings, and so on. How to think about it?
That's a very good point. You see, once you introduce this kind of friction, clearly the framework of complete markets no longer works. This is clearly not the case. In some countries, you can invest in, but cannot take your money out unless you sign a bunch of papers and the government agrees. So we need to think about those frictions. I think here, the simple approach that we use with Hanno of just putting a wedge between the change in exchange rate and the two SDFs, that's not going to be enough. We really need to think about who can invest and who cannot. So because it's not, again, if you just restrict the set of assets that people can invest in, it doesn't seem to be a very promising way to understand those processes. I don't have the answer to this. It's a research avenue for the next 10 years, if not before. If not more, I mean, I don't know. It's like, this is big. This is a big question.
One more question came up, just like regarding your slides or generally the literature, usually everything is in terms of or relative to the US dollar. So the question is, does the numeraire matter for the exchange rate factor structure?
That's a very good question. I think Nick is going to show you that in his slide. Let me just explain something simple. If you think about the exchange rate, let me take the intuition from the complete markets. If you think about the exchange rate as just a ratio or a difference in logs of two SDFs, it seems to matter how you define it, whether you use one base currency or another, whether you define US dollar or not. But if you think about risk, then it's not clear why it matters so much anymore, right? Because think about those SDFs as being driven by two kinds of shocks. Ones that are country-specific and ones that are global shocks. Now, when I look at the difference in two SDFs, and Nick will show you that in a very precise examples, the global shocks only remain in the exchange rates if the two SDFs have different loadings on those global shocks. And what about the country-specific shocks? Well, the country-specific shocks, if I have enough currencies in the portfolio, they're going to average out. They don't matter. So why does it answer the question? If you want to be able to capture a global risk factor that is driving exchange rates, you need to look at the difference between two SDFs that load differently in those global shocks. And as long as you do that, you're fine. So you could look at an SDF of US versus the UK, if you define all the exchange rates with respect to the US dollar, but you can also define all the exchange rates with respect to maybe the euro, and then you're going to look at the difference between the UK SDF and the euro SDF, and it's totally fine, as long as those two SDFs don't have the same loading on the global shocks. Because if they had the same loading on the global shocks, this would cancel out. So this is the answer to the question. When you think about exchange rate risk, you could think about expressing everything in any base currency, as long as the stochastic factor of your base currency has a loading on the global shock that is different from the other ones. And so that's a bit of a convoluted answer, but that's basically what we know. And what Nick is going to show you when I stop is that there's on top of that something special about the US maybe and the US SDF. It's a very good question again.
Thank you.
Nick, maybe I should stop because if not, you won't have enough time, right?
Well, if there's still questions, you should still answer them. But I think
I'm happy to answer. Sure.
That was all the questions from the chat. So in case people have more questions.
So I think this maybe is a good time then for us to take a break, and we'll come back. Let's say 10 minutes before 2 o'clock Eastern time. So in I guess just over 15 minutes, between 15 and 20 minutes from now. But let's plan 1:50 to be the start time. So I hope everybody can stay on or rejoin. Thanks a lot to Adrien for a great talk, great lecture, and I will build on what Adrien said. And as he said, I'll go a little bit deeper in some of the areas, and I will really try to kind of highlight the outstanding questions that I think are super exciting areas for people to work on. In addition, of course, to what Adrien talked about in his segment. So thanks a lot, everyone, and we'll see you back now in well, about 12-15 minutes, right? Thanks a lot. Thanks, Adrien. Okay, thanks everyone for being here again and for staying on for the second half, or hopefully I'll fit into the time that I've left for myself. But please do continue posting your questions to chat, and Anna will answer. And Adrien, if there's any questions that come in following up on what you said, feel free to answer them in chat or interrupt me and if you want me to say something. All right, so of course this was a bit of a grandiose title, Macro Finance Across Borders. As you all see, we're talking about exchange rates primarily, and behavior of exchange rates from largely an asset pricing point of view, but trying to interface with macro as much as possible. And I will in particular focus on, well, risk premia being a big component of what Adrien talked about, but thinking about conditional and unconditional risk premia in a way that is perhaps a little bit more specific, but then also connecting to a little bit the earlier historical literature on exchange rate predictability, but also to the burgeoning literature that Adrien also mentioned that links to the behavior of intermediaries, monetary policy, and of trying to understand what are the key outstanding questions that we should be trying to answer in this literature. So I'll try to go fast at the beginning, but please stop me. Again, as Adrien said in the beginning of his talk, the consensus view perhaps at the beginning of the 21st century in the field of international finance was that exchange rates are basically random walks, and there's this U.L.P relationship that's supposed to capture behavior of exchange, joint behavior of exchange rates and interest rates in the world without currency risk premium, not necessarily risk neutral world, but the world where forward prices are unbiased expectations of future spot rates and the exchange rate world in particular, that relationship fails, but we don't really know why. And there's some evidence that this U.L.P relationship works better at longer horizons. Now, of course, it's much harder to measure interest rate differentials and adjustment of exchange rates to offset those at longer horizon. There was also some evidence already at that point in time that there is predictability at the very high frequency, mostly potentially due to microstructure effects, but generally looking at flows. And in fact, this has been also a very active literature now. I don't have all the references here, but it's certainly there's been a lot of work recently trying to understand how the flows in the exchange rate markets drive predictability. So what Adrien talked about, going back to our work with Hannah, was primarily this sorting on interest rates or interest rate differentials or forward discounts that gives rise to this high minus low carry trade factor. I will focus primarily on, as far as talking about our joint work, I'll focus primarily on the second, in some sense, to me, even more puzzling fact that we document, which is what we call the dollar carry trade. And link it to some of this literature on exchange rate predictability in particular, and also try to understand show why it's so puzzling and why this is perhaps the area where we need the most work to try to understand what is going on. And I will use a no arbitrage framework that we had developed for those in those papers to kind of try to make some sense of this evidence. So what is the dollar carry trade? Unlike the carry trade strategies that Adrien talked about before, what we call the dollar carry trade is a carry trade that is formed by buying or selling short a portfolio or basket of exchange rates, currencies, vis-a-vis the dollar. And in particular, why is it a carry trade? Well, when the dollar interest rate is higher than the average interest rate abroad, then you go long the dollar and short the foreign currency baskets, and vice versa. When the dollar interest rate or U.S. interest rate is low relative to the foreign currency interest rate, you buy foreign currency, you short the dollar. Now, of course, it matters which currencies or which interest rates you include in the baskets, because if you include emerging country currencies in particular that are prone to maybe high inflation or very sensitive to stress in financial markets, as you see in this graph, the Asian financial crisis in particular, these interest rate differentials behave very differently compared to interest rate differentials that only include developed country currencies. So in what I'm going to talk about going forward, the dollar carry trade is formed by looking at the interest rate differential between the US and a group of developed countries, in particular, not in all of this work, but you can specialize it to even the most liquid currencies, the so-called G10 currencies, although in much of what I'm going to do, we use a larger basket of developed country currencies to construct what we call the average forward discount, which is this average interest rate differential between foreign countries' currencies, foreign countries' interest rates, and the U.S. interest rate. And what we showed is that this dollar carry trade which is formed by going short the dollar when this AFD is positive and long the dollar when this AFD is negative, is a highly profitable trading strategy. And it seems completely unrelated to this high minus low carry trade strategies. Now, of course, if you do bilateral carry trade strategies for every currency pair, you go long the high interest rate currency and short the low interest rate currency, you're going to pick up elements of both the dollar carry trade and the high minus low carry trade, but it's a very kind of inefficient way to extract average returns, as we show, because if you compare the performance of these strategies over time, both the high minus low carry trade and especially this dollar carry trade blow out of the water the sort of this country level pairwise, very naive carry trade strategy. Now here we scaled up the returns on these currency portfolios to have the same volatility as the S&P 500 because they have higher Sharpe ratios. You get these really impressive looking cumulative returns, but that's again because currency strategies are less volatile, but they have high Sharpe ratios. And this dollar carry Sharpe ratio of 0.66 roughly, well, not only kind of blows out of the water what we would call sort of naive bilateral carry trade, but even our HML carry trade strategy in this subsample, and of course beat the equity markets. You can include emerging country currencies in the basket that you trade as long as you still use developed country AFD to construct a strategy. It still works very well. One might ask, well, how has this thing worked, in fact, since publication? And here we have to be honest, it has not been as impressive as it was before we published, especially in our original sample, which ended right about here. Now the dollar carry trade did recover very well, very strongly from the global financial crisis, and then did quite well going into the sovereign debt crisis. It had not done as well during the middle of the last decade, but again in the last couple years, especially in 2018, which was generally a bad year for equities and all pretty much quantitative factor strategies that are popular in sort of quant investment space, the dollar carry trade actually did quite well. So even though it's sort of flat for the decade, you could say, slightly, it's done well in times, in fact, where the world has looked riskier and investors would have appreciated having that as part of their basket. So it's even though maybe not as attractive during this time period unconditionally, it is still kind of an attractive strategy conditionally. And this, another decade of data only brings down the Sharpe ratio of the dollar carry trade for the whole sample only slightly. So I'm going to focus, of course, on the earlier evidence that we had, but I will argue that this is still kind of a very puzzling fact, an important fact for us to understand, especially given all the discussion these days about, well, what is going to happen to the dollar going forward. We have this massive fiscal expansion in the United States, of course, to combat the COVID crisis. And the dollar had rallied going into the crisis, into the recession, and now gold is rallying, and on the fears in particular of dollar, if not demise, at least long run dollar depreciation. That would potentially be expected given our evidence if the US dollar interest rate was now lower than the average foreign country interest rate. The problem is, and this is perhaps also the problem with this the 2010, 2015, 2017 period, is that we're at the zero lower bound in the US. And some of the other countries, of course, gone to negative interest rates, which the Federal Reserve, for a variety of reasons, refuses to do. And so measuring average forward discount in this world, it becomes tricky. And that's another kind of caveat to why perhaps the dollar carry trade has not performed as well in this last decade, because when you're at the zero lower bound, but not all countries respect that bound to the same extent, it's not exactly clear how you should construct this strategy kind of quote unquote correctly. And in fact, this is something that somebody should figure out. We certainly did not think about it at the time because there was in the data at the point of us writing the paper, there was very little experience of zero lower bound being actually binding. So I'm going to talk about this being as a profitable strategy. Well, why is this a profitable strategy? Well, because conditioning on the average forward discount, you can predict subsequent returns, excess returns, and in fact, you can predict exchange rate appreciation or depreciation. And there's lots of regression evidence that we had documented. Again, it works for developed country currencies and emerging country currencies, but as long as you use the average forward discount of the developed countries. So basically, these are what Adrien showed in the beginning out of the FAMA regressions, where you would expect this kappa coefficient to be positive and this zeta coefficient to be, kappa coefficient should be 0 and zeta coefficient should be negative, so that high interest rate currencies subsequently depreciate. Not just should it be negative, it should be -1. And of course, in the data, both of these coefficients are positive. Now, you could say zeta is not statistically significantly positive, but it's clearly not -1. And the predictability for expected excess returns is very, very statistically strongly significant for horizons between 1 month and 12 months, for which we have these forward discounts. Now, what is also interesting is that if you put a bunch of currencies into a panel regression, and that was another standard way to test these, U.I.P. Relation, alternative to the FAMA regressions, and you put into this regression both the average forward discount and the country-specific forward discount, you get that it's the average forward discount that drives all of the expected returns, all of the exchange rate predictability, in fact, and not the country-specific forward discount. So this is kind of an interesting, maybe surprising fact. Why is this the average forward discount that matters, and not the bilateral one? Well, there's a nice paper by Hassan and Mano that Adrien pointed out that provides this nice decomposition in this panel regression setting of the violations of U.I.P. that can be thought of as unconditional and conditional. So if you run a standard FAMA regression and here by Q I mean real exchange rates, but you can also do that in nominal where we use the S letter, as Adrien did. Exchange rate changes on interest rate differential. Well, we typically ignore the intercept, but the intercept does matter, especially when we do this for returns, because it tells you the unconditional expected returns that you earn by investing in currency I vis-a-vis your home currency. And so that captures the unconditional piece, and then the slope coefficient of beta captures the conditional piece, how much you earn per unit of interest rate difference. Now, if you put this into a panel, what Hassan and Mano find that pretty much all of the violations of U.I.P. can be attributed to either the country fixed effect, so basically these intercepts or alpha coefficients that are country specific but permanent, or time fixed effect, or in other words, variation in the country's currencies vis-a-vis the dollar. So there's very little of country times currency, country times time, contribution to currency risk premiums. So basically, we can either think about the cross-sectional differences in countries that are basically permanent or at least very, very persistent, and these would be these unconditional currency risk premium. And that's kind of what you find when you start sorting countries based on interest rate differentials, a variety of other measures that Adrien mentioned, and I'll talk a little bit about that as well. Or you just look at the country's currencies vis-a-vis the dollar, and this is what the average forward discount seems to be picking up, that it seems to be picking up this conditional risk premium that is associated with where the US interest rate is relative to the rest of the world, or at least of the developed countries. And that seems to be enough to kind of span the bulk, if not all, of the exchange rate predictability or the currency risk premia from the standpoint of the carry trade, how much of the interest rate the differential translates into average returns. So this is kind of the interesting counterpoint or complement to what Adrien was talking about then, because if we can understand the cross-sectional carry trade separately, and we can understand the dollar carry trade separately, then together we pretty much understand everything there is to understand about exchange rate in relation to interest rate differentials. So the fact that this average forward discount is a better predictor of individual currency excess returns or exchange rate differentials than individual ones allows us to do that. But it's also in itself kind of puzzling, because most of our models in international finance are written in a way where it's the bilateral differences that matter. It's the differences between the two countries that matter. It's not the difference between one particular specific country, the US, and everybody else that matters. And this is what I'm going to kind of lead towards, is trying to understand what kind of models do we need, what kind of models will and will not work. And there is lots of scope for research in this area. Now, why is it necessarily the dollar, and why is that the dollar interest rate? Well, one hint is that this average forward discount, at least for the dollar, is very strongly countercyclical. U.S. interest rates are low relative to the rest of the, let's say, developed world when U.S. goes into recession. And we see this, of course, whenever as the U.S. goes into recession, the Fed cuts rates aggressively. Now, again, zero lower bound is kind of a problem, but before we had a zero lower bound, there was a pretty consistent fact that the Fed cuts rates aggressively going into the recession. And then as the economy recovers, the rates start rising. And to the extent that U.S. recessions are not perfectly synchronized with other developed countries or kind of the world recessions, even though yes, they have been, of course, global recessions, both the Great Recession and global financial crisis and the COVID-induced recessions are global recessions. The monetary policy of the Federal Reserve versus the ECB, the Bank of Japan, the Bank of England, and so on, are not perfectly synchronized, even though, of course, everybody is fundamentally trying to do the same thing. So what we see is that, and this is going back to the question of kind of disconnectedness, how does this relate to macro? We know that exchange rates don't seem to be very connected to business cycle variables. Well, what we see is that if we add to the average forward discount a macroeconomic variable that captures the state of the business cycle in the US, and in particular here we're using growth of industrial production, we see that in fact, growth of industrial production very strongly negatively predicts currency returns, which means that this is foreign currency vis-a-vis the US, which means that when the US goes into recession, on impact, perhaps dollar appreciates, but it's expected to depreciate going forward, resulting in a risk premium to an investor who is long foreign currency and short the dollar, again, in a US recession. And of course, the opposite happens during a boom. And in fact, it's this counter-cyclical behavior of the average forward discount that captures the risk premium, because it seems like the forward discount itself, while controlling for the state of the business cycle, is not nearly as powerful as a predictor. So again, there's something special, it seems like, about the dollar and average forward discount that has to do with the U.S. business cycle, and maybe with the relation between the U.S. business cycle and the global business cycle. And one way we can see this is we can kind of orthogonalize the U.S. industrial production with respect to that of the rest of the OECD countries. And indeed, we see that it's this residual of the U.S. industrial production growth with respect to the foreign industrial production growth that delivers this strong counter-cyclical behavior of currency risk premia with pretty impressive Sharpe ratios given, R squares, which of course translate into Sharpe ratios at 6 to 12 months horizons. I don't know if I'm talking too fast. Maybe I should stop for a second if there are questions before I go to the next step, because what I want to do next is I want to kind of talk about how we think about sort of models, what sort of models would be needed to reconcile this this evidence, and maybe is there sort of a way of slowing me down and everybody else catching, you know, I don't know, maybe everybody is ahead of me already, but if not, maybe for everybody to catch up, let me know if there are questions.
Yes, so far there's one question in the chat. Does it still make sense to use forward discounts to measure carry trade returns, given that the last session on pervasive CAP violations?
Very good question. It's a tough question because in some sense, if you are going to be trying to take advantage of the carry trade, you're ultimately most likely going to be doing it using a forward contract. Now, it could be that it is the pressure from the carry traders that is driving some of that CIP violation that Adrien talked about. We don't really know that yet, but the fact that the CIP violation seems to line up with interest rate differentials, at least in terms of sign, and Adrien can correct me if I'm wrong, is consistent with people trying to buy high interest rate currencies and short low interest rate currencies. And arbitrageurs on the other side who are kind of doing the arbitrage of CIP by lining up the money market rates, so the Libor rates really, with the forward discounts do not provide enough capital to make that arbitrage hold. Again, Adrien will correct me if that doesn't quite make sense, but my sense is that if you have access to forward contracts, it's just easier to implement the trade in a forward contract, even though you might be losing some of the carry to the CIP deviations, because you need to compensate the arbitrageurs for providing the, basically you need to compensate the investment banks who are going to write these forward contracts with you. Of course, you can do the same thing in the futures markets, and which are not actually as liquid as the forward markets when it comes to FX. But unless you are yourself a bank doing this in actual cash markets, meaning borrow at US Libor, let's say, lend in all these foreign currencies Libor, is going to be quite difficult. Maybe it's a preferred way to go in terms of taking advantage of the interest rate differential, but it's not everybody has access to it, and even for a typical hedge fund, it's much more natural to do it through forward markets or futures markets. Now, maybe the follow-up question to that would be, well, maybe should we be measuring the average forward discount somehow differently? One way we could do it is look at real interest rate differentials, because nominal interest rate differentials are subject to the zero lower bound thing, but the real ones are not, right? So that's maybe that the kind of a way to measure which way the trade should go should be done using real quantities, not the forward discount. That is very fair and possible. I don't think we have tried that, and I don't know if anybody else had tried that. All right, Adrien, you want to add anything?
No, that's perfect. I think when we study the excess return now and we use the forward rates, as the question asked, it's true that now we are maybe studying two things. One is the CIP deviation and one is U.L.P deviations, and that's going to make our life a little bit more difficult going forward. On average, as I told you, it's a 50 basis point for the CIP deviation versus 500 basis point for the U.L.P deviation. So on average, you would think that even if you make a small mistake on the forward, it's still okay. But that's just a statement about the average. And there are large time series variation in the CIP deviation. So I think it's a very good question. And now we're going to have to be extremely careful when we study those excess returns. And the thing is that if you implement it on the forward, because of the sign of the CIP deviations, the excess returns are even bigger than if you implement it on the cash market, as Nick said. So it's a very good question, and it's going to make our life a little bit more difficult.
Thanks, Adrien. All right, so next step, how do we make sense of this? And the way that Adrien and Hanno and I have been trying to make sense of this, which builds a lot, of course, on the work of Backus, Ferezi, and Telmar, is by using a reduced form affine stochastic discount factor. Now, an affine reduced form stochastic discount factor, one could say, is not an explanation of anything, because we don't know where it comes from and how does it tie to macro variables. And I will talk about that a little bit later on. But for us, this is a convenient device for summarizing what conditions does a micro-founded macroeconomic model of stochastic discount factors, or in fact, maybe not just macroeconomic, but macroeconomic and microstructure and intermediation influenced model of stochastic discount factors would have to possess in order to be able to satisfy the evidence, the empirical evidence that we have been talking about. Again, of course, this is subject to the assumption of complete financial markets. If you go to incomplete markets, things become a little bit more complicated, because, of course, in incomplete markets, these SDFs are not unique. So for now, let's just stay in the world of complete markets, and remember that ultimately, if we want to understand exchange rate behavior, we want to understand how these stochastic discount factors in different numeraires in different countries' currencies behave vis-a-vis each other. And of course, again, they could behave vis-a-vis each other in different ways for different reasons that we cannot say anything about without putting more kind of macroeconomic structure. So if we're talking about these reduced form stochastic discount factors, what we ultimately want to understand is the conditional means, right, that are going to determine the interest rates and interest rate differentials, and conditional volatilities or conditional variances, which drive the risk premium, again, as Adrien discussed in his lecture. Of course, you could go to higher moments, and higher moments might be important. For simplicity, we're leaving these out, and so this gives us a fairly simple affine or log normal structure, conditionally log normal structure, where we are going to follow, as I said, Backus, Ferezi, and Telmar, use a Cox-Ingersoll-Ross type square root process adapted to discrete time. Now, of course, we all know these processes don't technically exist in discrete time. You need continuous time so that you never get a negative number inside a square root. We think of this as a convenient qualitative device, and when we are taking it to the data, we're making sure that that the probabilities of those kind of zero bounds being breached are negligible, so that you can simulate and estimate stuff. I'm not going to go to that quantitative part today at all. I'm only going to talk about qualitative things anyway. So what we kind of try to do is to write down a minimal stochastic discount factor that has the least structure necessary to explain the facts that we had identified. Now, what do you need for that? Well, we need shocks that are both country specific or currency specific or numeraire specific and global. And the reason for that, of course, is that if you only have country-specific shocks, you will have, in order to match the magnitudes of average returns or Sharpe ratios that we see in currency markets, you will have enormous volatility in exchange rates. That's number one. And number two, remember, we uncovered the factor structure in currency returns, again, as Adrien talked about, which means that there is a large global component that is shared by exchange rates and therefore stochastic discount factors of all the currencies in our sample that seems to dominate, by far dominate the variation in exchange rates. And Adrien has another nice paper that he didn't talk about that goes more deeply into that factor structure. But it turns out that not only do you need one global kind of innovation, a global shock in the stochastic discount factor, but you need two global shocks. And in fact, we didn't really see that until we discovered this dollar dollar carry trade, because in order to explain the high minus low carry trade, it was enough to have one global shock and heterogeneity in the exposures of different currencies to that global shock. So let me begin with that. What does that heterogeneity mean? What does it do? Well, countries that are more exposed, or their SDFs more exposed to that global shocks, those countries would be riskier countries in the sense that their stochastic discount factor is more volatile. But it also means that those countries that SDFs rise more in bad times, and as their SDFs rise more in bad times, those currencies appreciate. So those are safe haven currencies, but these are not safe countries, or at least their SDFs are more volatile and more exposed to global shocks. So think about Japan, for example. The Japanese yen is a safe haven currency in the sense that it appreciates at bad times, but it's not because Japan is a safe country. In fact, when the Fukushima disaster happened, which was clearly bad shock to the marginal utility of a Japanese consumer or Japanese investor, yen also appreciated quite dramatically, which is exactly consistent with this type of model. And on the flip side, this also means that countries that have least exposure to global shocks are themselves, and they might be sort of safe from the standpoint of their marginal utility. Their currencies will be risky because they will be appreciating at good times and depreciating in bad times. So that's why we need this heterogeneity in the exposures to this first global shock. But that heterogeneity can be kind of permanent or very highly persistent. And how to think of this shock, this W shock? Well, Adrien showed evidence on global volatility, for example, that's very much consistent with that. When global volatility spikes, again, it's these safe haven currencies like Japan and Switzerland. Their currencies appreciate. The riskier currencies like the Australian dollar, New Zealand dollar, and Norwegian krone, and so on, they depreciate, and that drives these differences in the portfolio returns, and therefore drives the risk of the carry trade. But because I showed the correlation of the dollar carry trade and the HML carry trade is very low, that means that there's got to be another shock that is important and is global, is shared by all the countries, since we're talking about the US dollar vis-a-vis everybody else, all other currencies, and exposure to that shock varies over time with the state of the US business cycle. So even though the shock is common, the exposure to this shock varies here country by country from period to period. And so these two state variables capture the variation and sort of the exposure of countries to this global shock over time individually. That's the ZI. And the ZW captures the time varying of price maybe of this global world risk, like the volatility risk, for example. And it's natural to have sort of this minus signs. This is unusual generally for, let's say, an interest rate CIR model to have the minus signs here. It is important, of course, for us because these shocks capture the prices of risk. And given the evidence that we show, the prices of risk, especially the ZI, have to be counter-cyclical to be consistent with the evidence. So these prices of risk that increase, when the shocks that increase prices of risk have to come in bad times that are by raising marginal utility or the stochastic discount factor. Now, what do exchange rates look like in a model like this? Well, the innovation to, let's say, euro versus dollar exchange rate, of course, just driven by in logs by differences in the innovations to their stochastic discount factors. Once you kind of write it out and put everything together, well, there are the country-specific or currency-specific shocks, and then there are the two global shocks. And again, what matters, whether these global shocks cancel out or not, is this heterogeneity. So if the US and the Eurozone have the same exposure to the global shock, then the shock will not show up in their exchange rate. It will only show up in their exchange rate if they have different exposure unconditionally. For the other global shock, what matters is the differences in their business cycle. If right now U.S., let's say, is in a deeper recession, let's say, than in the Eurozone, then U.S. will be more exposed to this global shock than the Eurozone, or vice versa. And again, there are, of course, the currency or numeraire specific shocks as well, but as I said, they have to be fairly small quantitatively, and otherwise we're going to observe dramatically higher volatility of exchange rates than we actually do observe. So it has to be that the bulk of the variation comes from these global shocks, and it's precisely because even though there are large prices of risk associated with these shocks, most of the time they don't cancel out exactly, but they nearly cancel out. So the volatility of exchange rate is not too high. So what do forward discounts look like in this economy? Well, because everything is affine, the forward discount vis-a-vis currency I is driven by the difference of the currency I's local or country-specific shock and the U.S. Or country-specific state variable, as well as by the differences in their exposures to the global state variable. And again, if the U.S. was the average quote-unquote country in terms of its exposures, and we'll see why that's kind of important, then the second term would cancel out, and we really would just have the difference between the U.S. business cycle and the other countries' average sort of state of the business cycle entering into the average forward discount. And of course, with the sign that's controlled by these parameters here, but basically you need the risk terms that show up in the sort of this Jensen component dominating, so that we get counter-cyclical forward discount, so that the average forward discount is high when US is at the low point of its business cycle, and vice versa, because then it will translate directly into these counter-cyclical risk premia, because of course only the risk terms matter for the risk premia. And so if this piece lines up with this piece, then you get basically one-for-one translation of the interest rate differential into expected excess return. That is in the case where these deltas are the same, and so the ZW shock cancels out. Of course, these Z's are almost never the same because they're time varying and driven by each country's individual shocks. And this is important, especially important when you're putting currencies into a basket, because then really it becomes the U.S. country-specific business cycle that drives fluctuations both in its average forward discount and in the risk premium that is earned by going either long or short the dollar vis-a-vis everybody else. So if you do this, if you put a bunch of countries into a basket, what do you get? Well, basically it's the same thing that as I showed before, except now it's the country-specific shocks averaged across the basket. So that's going to go to zero because they're presumably IID across countries. That's what makes them country-specific. The U.S.-specific shock will, of course, be there, but as I said, that is relatively small. If the U.S. is an average country in terms of its exposure to global shocks, this first term global term will drop out. Why is this a natural assumption? Well, it's a natural assumption given that we know that on average, investing in the dollar or shorting the dollar unconditionally does not earn much of a risk premium. If it did, then it would be important for the US to not have the same exposure to the global shock as an average country. But given that on average, again, the dollar risk premium seems to be close to zero, it has to be that in terms of the exposure to this global, let's say, volatility shock, the US is a relatively average country. Now, this might seem surprising, and in fact, it is surprising from standpoints of some of the models that I will talk about later, because the US is the largest economy after all. How come can it be average? Well, again, if it's not average, then if it's, for example, the largest country and hence exposed to the biggest part of the global risk, then this delta US will be large. and larger than the average, and the US dollar will on average have a lower interest rate than a typical country in the world, and will earn a negative return, or investing in the dollar will on average earn a negative return. There is a little bit of evidence of that, but it's very weak. Depending on the length of the sample, it's roughly close to zero. Now, this is not going to help us with the average forward discount almost at all, because for the average forward discount, we need the variation in the US variable relative to everybody else. And this is where this last piece comes in. And of course, the average across the basket will go to zero with a large enough number of countries. And so it's the state of the US business cycle vis-a-vis the world that is going to be driving. So this time varying market price of risk comes from the state of the US business cycle and its exposure to the global shock. Now, I will skip the rest of the math here, but because I think it's kind of clear by now. One important piece here that helps kind of argue that US has to be an average country is the fact that the average forward discount is a more powerful predictor of even bilateral exchange rate returns than a country-specific bilateral forward discount. We can actually derive these Fama coefficients inside the model, and what we see is that in the bilateral forward discount, the regression coefficient is smaller as long as the country is different from the average country. But of course, when the country is the average, this piece drops out, which is what happens in the case of the average forward discount. So this denominator term kind of shrinks, and this is why the average forward discount is a more powerful predictor of exchange rates than individual bilateral forward discount. And again, this only happens if country is kind of average in terms of its exposure to the global shock. And I will kind of make a point why this is important in a second, but let me maybe pause for 1 second if there are questions, so that again I don't lose everybody. Questions?
I think there's no questions at this point unless somebody wants to raise their hands.
No problem. So okay. So one thing I'm going to show before switching gears is that how the high minus low carry trade relates to the dollar carry trade very much depends on this average exposure to the global shock, because we can do this exercise for any country. Some of them might be more exposed to the global shock, some of them might be less exposed to the global shock, and we can compute their correlation of their high minus low carry trade, which is basically the same regardless of which country's currency you use as a base currency, and their base currency carry trade, which is the trade of their currency vis-a-vis everybody else based on the sign of this average forward discount. And what you see is that the correlation between these two carry trade strategies depends on whether the country is quote unquote average in terms of its this delta exposure to the global shock, or is it kind of to the right or to the left? What I mean by this is that countries that are heavily exposed to the global shock, so this again Japan or Switzerland, will have low interest rates and on average high average forward discounts. For them, there's going to be little distinction between this base carry trade and the high minus low carry trade. You're almost always short Japan, you're almost always short Switzerland based on the sign of this average forward discount or the bilateral forward discount. The reverse is true for New Zealand. The same is true for New Zealand, even though they're on the other end of the spectrum. They're the least exposed currencies. Again, not currencies, but these countries' stochastic discount factors are least exposed to the global shock. That doesn't mean that these currencies are not risky. In fact, that's what makes these currencies risky. That's why they depreciate in bad times. But again, from those countries' standpoint, the base carry versus high minus low carry is almost the same thing. You're always long these currencies, and you're short Japan and Switzerland. It's the countries in the middle, like again, U.S. to some extent UK, but mostly US, the euro, and the Canadian dollar, for whom these two strategies are very different, because the high minus low carry strategy goes long Japan, long Australia and New Zealand, short Japan and Swiss franc, let's say, most of the time, of course. Whereas the average forward discount is going to be changing signs a lot, and you go long one or the other. And this is kind of well captured, turns out, by this affine model, except that you see that US is a bit of an outlier. So that for the US, this average forward discount is even more powerful predictor of expected returns than this type of model would be able to explain. So this is not potentially everything. This says that there is something else that is special potentially about the dollar that makes this dollar carry trade so strong and so powerful, even though by and large it's consistent with the idea that the US dollar is average in terms of its exposure to global risk on average, even though it's more exposed for this dollar carry strategy to work in bad macroeconomic times in US recessions. Now, Adrien talked about this already, so I'm going to go very quickly. We have a number of stories, and by stories I mean models, typically very well validated in the data, of sources of differences in unconditional risk premia. These sources of deltas, the differences of where the countries lie on this spectrum that I just showed before, starting from country size, going back to Tarek Hassan's work, to interconnectedness in a centrality in the trade network. That's work by Rob Richmond in particular. There's, of course, now interesting work on intermediation, and Majori's work on kind of countries' absorption of global risk makes it, well, for the US, its ability to absorb a lot of global risk makes it sort of the global risk taker of last resort, makes it most exposed to the kind of the global potentially financial conditions. So that doesn't make it average, but if you kind of go a little bit deeper, there's a nice paper by Zhang Fang, who is using this limited risk sharing and intermediation constraint in conjunction with differences in nominal monetary policy, nominal interest rate setting, and differences in those that generates actually nice heterogeneity that is kind of consistent with the type of facts that we see. I'll talk briefly about the evidence in my paper with Rob Brady and Colin Ward about commodity trade. Commodity trade is one of those variables, in fact, where US is, in fact, an average country. What I mean by the average, and of course, again, there's lots of papers that have been written on this, and more papers should be written. I think this is still a wide open area. I'm just highlighting a little bit of what I think is kind of maybe surprising, that the dollar or US is indeed an average country in terms of its combination of net imports or ratio of net imports of, let's say, commodities and basic goods versus complex manufactured goods. And so again, our paper does not speak at all to the US dollar. It mostly speaks to these unconditional differences, showing that countries in Japan that are heavily exporting manufactured goods and importing their commodities are in some sense risky because they absorb global productivity shocks, whereas countries, again, that are commodity exporters are naturally cushioned by the sort of the Dutch disease type mechanism. Again, I'm not going to go in the details, but their currencies, of course, are very risky, precisely those currencies, because those currencies move with commodity prices, and commodity prices are very susceptible to the global cycle. Brief digression, there was a comment about Backus-Smith earlier, and how come we can think about sort of connecting these facts to macroeconomics, since we know that consumption growth in particular is very disconnected from exchange rates, and indeed that's, they're disconnected. Exchange rates are disconnected from a number of macro variables. So it's not just enough to get the volatility of stochastic discount factors right. We need to get correlations to work as well if we're going to have a macro model. Now, of course, these intermediation-based models try to break this and say, well, markets are incomplete. You don't expect the representative consumer to be on this first order condition, on the Euler condition with the exchange rate. So you don't expect this correlation to hold. Well, interestingly, qualitatively, if you look at these countries that are commodity exporters versus commodity importers, not only did their currencies, the currencies of commodity exporters fall dramatically in the global financial crisis, and Japanese yen and Swiss franc appreciated, but also their macro fundamentals dramatically diverged as well. So it's these low interest rate currencies that are in the sense of our models are riskier countries that suffered bigger declines in both their output or labor productivity. In fact, if we go to the Balassa-Samuelson effect, then the commodity countries, but even their consumption, even though consumption, of course, is very smooth generally, and it's hard to see much of consumption risk at high frequency, you see that over the course of the Great Recession and recovery from the Great Recession, the commodity countries overall, if they suffer, didn't really, except for New Zealand, suffer a decline in consumption, and for the most part appreciated, or their consumption grew, whereas it's this the final good manufacturing developed economies that suffered the biggest declines in consumption and recovered most weakly. So of course these are very, very, very imperfect, but at least qualitatively there is some sense that the Backus-Smith exchange rate disconnect maybe is not so disconnected. There is some, depending on as Adrien said, depending on whether you look conditionally or unconditionally, you may be able to see something. Now I'm going to be probably going over time, but this is where I'm kind of getting to what I think are outstanding really questions and puzzles. To sort of summarize, we have a variety of facts now about the dollar that are kind of surprising. So there's the fact that the unconditional risk premium is close to zero suggests that the US is an average country in terms of its exposure to the global shocks. This just seems to be hard to believe, even though it's consistent with some of this trade evidence that I showed. It's certainly not consistent with evidence based on, let's say, the global risk capacity, or certainly the size of the country's market or consumption, and so on and so forth. I showed evidence that its risk premium is strongly counter-cyclical, which again requires it to be both average and have a very volatile kind of exposure to global shocks and global financial conditions. Maybe it has something to do with U.S. monetary policy. Maybe it has something to do with the role of the U.S. as a risk bearer of last resort, but it's certainly not in the models that we know by now very well. Another kind of puzzling fact that has been, I think, getting quite a lot of attention in the academic world, because it's so natural to most practitioners, is that interest rates typically, when interest rates appreciate, that leads to an appreciation of the currency. Sorry, when interest rates rise, it leads to an appreciation of the currency, which is consistent, in fact, with the U.L.P logic, because as your interest rate appreciates, your currency should rise in impact because it's supposed to depreciate subsequently. We know the latter is not true. We don't see that subsequent depreciation. So why should it on impact appreciation happen? And in fact, it goes against all of our models where risk premium are counter-cyclical, because if a risk premium is counter-cyclical, then my country's interest rate going up signals that I demand less of a risk premium going forward. So that should be happening in good times if risk premium are counter-cyclical. So should be that my stochastic discount factor falls relative to the other countries' stochastic discount factors, and so the currency should depreciate. And this logic applies to the real exchange rates and real interest rates, and in fact, Engel's evidence is for the real exchange rates and interest rates. So this is something, again, that it's totally standard, I think, to most practitioners, that when the Fed cuts rates, the dollar on impact depreciates. And in fact, we see that the market should be anticipating this, and this is from Nina's work, showing that in fact, you by looking at the Fed funds futures, whether the futures markets expect the Fed to cut or raise rates, you can, in a couple of days before the Fed decision is announced, you can buy or short the dollar depending on the direction of the Fed policy, and you can generate pretty high Sharpe ratios doing that, even though you can of course only do this but so many times given the frequency of the FOMC policy decisions. That's kind of another puzzle that lays on top of the angle puzzle, the fact that how can we reconcile the countercyclical risk premia with the fact that on impact interest rates in fact go in the opposite direction. Another way to think about this puzzle is to think about the long-term versus short-term risk premia in FX. And this is, again, I know I don't have a lot of time, so I'm going to try to go quickly, but my slides will be out there for everyone. And in fact, I tried to link to the papers, especially the working papers following an Andrea, so that the folks can find them. If you do kind of a Campbell-Schiller type decomposition, you basically write a real exchange rate as a forward-looking price, and we write it as a sum of future cash flows, which is future interest rate differentials, and future excess returns that you earn on that currency, plus, of course, that transversality term that we talked about earlier. Most of this analysis assumes that in Engel's papers, as well as John Jung's paper, generally assumes that that real exchange rate is stationary, which, as Adrien talked about, is a reasonably good assumption. Using a VAR to compute the impulse responses to the future interest rates differentials and future excess returns gives you this variance or covariance decomposition, rather, where we see that as long as interest rate differentials are fairly persistent. So the first component, the covariance of interest rate differentials with future interest rate differentials, is positive. It means that the covariance of interest rate differentials with future returns has to be negative. But that goes against all of our carry trade evidence, where we know that interest rate differential, positive interest rate differential today predicts positive returns tomorrow. So that means that at some point, these risk premia change sign. Otherwise, we cannot reconcile, again, this risk premium evidence with the angle evidence. And in Jing Young's paper, he shows that they switch sign right at about 3 years out. Why 3 years out? Well, one kind of potential thought is that there are some really persistent monetary or maybe in fact fiscal shocks that play out at a longer horizons that we don't pick up when we do the U.L.P. regressions. I don't have much time to go through the impulse responses, but this kind of harks back to this earlier literature on delayed overshooting and exchange rate dark matter. What drives exchange rates? Most of our models that Adrien talked about in asset pricing are about the real exchange rate driven by differences in is conditional risk or risk premia, risk aversion, or magnitude of risk, depending whether you like the habit model, where it's risk aversion, or Epstein-Zinn long-run risk, where it's differences in uncertainty. Now, these monetary models talk about a reaction to monetary policy shocks, and what this evidence says that while there is an initial positive reaction that is not fully offsetting differences in interest rates, but then there is a subsequent overshooting. The more recent evidence that looks more carefully at these transitory and persistent or permanent components of shocks say that, well, they have the opposite effects that in fact are needed to reconcile the short-term versus long-term risk premia or their signs. So if we think of these long-term, very persistent monetary shocks being really fiscal shocks, shocks that are potentially right now, like we experiencing maybe a long-term fiscal shock, which hasn't yet fully played out, but people are expecting maybe we'll have inflation in 4 to 5 years. Maybe that is going to have to be there to reconcile sort of the government budget constraint with financial asset prices, then maybe this is where the signs of risk premia on an exchange rate in the future are opposite of the signs of risk premia on exchange rates today. And again, that's the graph from Jigyang Zhang's paper that kind of makes that point using a VAR. So again, kind of to summarize, that the puzzles the puzzles around the dollar are kind of growing rather than resolving themselves, in my view. In addition to the zero unconditional risk premium, highly volatile conditional risk premium, we have this appreciation of the dollar in the direction that goes against the countercyclical risk premium explanation, and in fact is to some extent forecastable. And the horizons of risk premia have these opposite signs. Short-term versus long-term risk premia have differences in their sign that might have something to do with monetary and or fiscal policy in a way that I would argue we don't yet fully understand. So what kind of models do we need to write? Well, this is a field that is wide open, and of course there is a lot of work being done in this area. One thing I promised I would mention, this work on quantity, sort of demand driven fluctuations. And of course, there's this recent work by Greenwood, Hansen, Stein, and Sundaram, and Gorinchas, Ray, and Vallanos. These are two separate papers that use fundamentally, I think, the same model and speak to the same kind of evidence. These are models that go beyond what we've seen in the intermediary literature, where only intermediaries are marginal in exchange rates. These models realize that, well, there's other demands that are buffeting exchange rates. There are real money traders. These are corporations doing actual physical trade that need to exchange currency from one to another, that are driving shocks to exchange rate, and that makes it risky for arbitrageurs. Even in a world where U.L.P would otherwise hold, they make it risky for arbitrageurs to take a position in the direction of the U.L.P, which is why we have this incomplete or delayed or overshooting, where the interest rates go up, exchange rate goes up on impact, but not all the way, and it continues to go up to compensate the arbitrageurs for bearing this risk. So this is, it may be a very, again, still a very stark view of what happens in financial markets, very different from the kind of complete markets models that Adrien and I were talking about earlier. But it still leaves, I think, a lot unanswered, because it doesn't tell you anything about why is it the dollar? What makes the dollar special? Because much of this evidence is very specific to the dollar. So why does it not, this mechanism also apply to other currencies as well, where we don't quite see, even the angle puzzle, it's not clear to what extent it applies to either bilateral country pairs that do not involve the dollar. And as I argued earlier, this conditional risk premium evidence is really about the dollar. It's much weaker, if not completely non-existent, for other base countries or base currencies. So why is it that the arbitrage is most constrained when betting on the dollar, as opposed to other currencies? Well, Nina and I are doing some work on this, but of course it's too preliminary to put out there. But I think more fundamentally, we have to again go back to understanding, well, what makes the dollar so special, which is, again, the super exciting area. Lots of papers are being written these days, and they have to do with, is it about the demand for U.S. safe assets? Is it about the fact that much of the global trade, about 80%, is invoiced in dollars? And not only is it invoiced in dollars, but if you're an exporter and if your trade is invoiced in dollar, you want trade credit also to be in dollar, which means that the fluctuations in the dollar become important for the real economy as well, through this trade credit channel. And there's just kind of potentially a lot of interaction between these different channels that ultimately have to work together to give us all these puzzles that I think are still outstanding. Again, maybe there is some interaction. Again, there's this recent paper by Moritz Linnell that talks about the safety premium maybe being time varying in a way that interacts with monetary policy. Again, I'm sure there are other papers that I have not covered. This was not the goal. The goal is to kind of outline kind of questions to be addressed and to be solved going forward. Wherever there are the working papers that are trying to do this, I'm trying to link to them, but please don't hesitate to share with me if I forgot something. I know I'm almost out of time, but let me take a breath and answer maybe if there are some questions. I should have probably done it earlier, but sorry. Questions?
Yes, we have a few questions. So the first one is from San-Young Kim. It seems to me that the reason why dollar carry trade is informative of global risk is because the US has average exposure to the global shock relative to non-US countries. Is the US exceptional in this regard? If other based countries, for instance the euro, have average global exposure relative to the outside world, does it imply these other base factor carry trades should also be informative of global risk?
That's a very good question. What my the affine structure that I wrote down implies is that yes, if your country is average in terms of its exposure to global shocks, then you should be seeing a lot of predictability using its base interest rate differential, base forward discount, right? Euro vis-a-vis everybody else. It turns out, and of course we did this when we wrote our paper, if you do these predictability regressions using perspective of other base countries that are also sort of average in terms of their average interest rate differentials, like again, the Euro, the UK, Canada, you sort of get there. It works better for these countries than it works for these outlier tail countries like Japan on the one hand or Australia on the other hand. So yes, in that sense, the logic of the model does work, but it almost never works as well for those countries as it works for the US. So it seems like, again, the dollar in some way is special, that the average forward discount is capturing more in the case of the dollar than it is in the case of the euro or Great Britain, which again, Great Britain maybe is a little bit to the side of commodity currencies in my graph earlier. But let's say US vis-a-vis the euro, there is some predictability for the euro, not nearly as much as for the US, and it could be because its time varying exposure to global shock is less volatile than the US is. That would be consistent with it. In our model, we kind of fix all the other parameters to be the same, but they need not be. So that's something that one could try to understand. Or is it, again, something special about this, maybe the dollar convenience premium that this recent literature talks about, that is layered on top of the general kind of business cycle risk exposure or risk aversion maybe, that is doing it, we don't really know. So there is something to be said for the dollar being special, even if it is average in some respects in terms of its exposure. There is more to it.
The next question is by Nina. Do you think that the special role of US policy for FX market may be also related to the high share of US dollar in total FX trading, and also the dominance of the dollar in global trade invoicing as well as borrowing?
Yeah, so this is kind of what I was alluding to in the end, and I guess that Nina wants me to talk more about this. But I think it might be that the reason that arbitrage is more limited when we are talking about the dollar is not that there's not enough arbitrage capital generally, but as Adrien showed, this is a huge market. And again, not only is 80 to 85% of currency kind of trade invoicing is done in the dollar. About 85%, I think, of FX trading involves dollar as one of the currencies. So most of the trade happens into the dollar, out of the dollar, in part presumably because most of the trade in the spot FX markets is done by non-financial participants, is done by companies that just have to conduct their normal import-export business, or maybe hedge some of the exposure that they accrue, which means from the standpoint of these models that I talked about, basically the Vianos and Vila type models, the arbitrageurs taking a bet against the dollar are potentially taking a lot more risk than arbitrageurs betting on an arbitrage deviation for another currency that does not have nearly as much flow volatility that is driven by other factors. What in these kind of arbitrage models, these are just noise traders, but of course these are not noise traders. These are not stupid people. These are non-financial traders trading for kind of real reasons, but the flows are so massive in these markets that it's very easy to be completely swamped, even if you're a large hedge fund betting on dollar appreciation or dollar depreciation. You think supposed to happen based on its U.L.P or CIP for that matter. There's just too much risk in these markets relative to other currencies, where it's much easier for a hedge fund to make a diversified, in fact, bet on a bunch of currencies, which is why their maybe CIP violations, for example, are driven out much more easily than the U.S. dollar CIP violations. And of course, these risk premia facts maybe do not apply anymore. I don't know if Adrien has any views on that to add to what I said. Is that Nina? But you know if you want to say something as well, go ahead.
No, I wrote that before you mentioned it in the end of the.
Oh, okay. Well, thank you. Okay.
Yeah. I agree.
So, is there anything else, Anna?
Yes, there's two more questions. One by Zhang Fan. What is the role of average foreign interest rates in predicting currency returns? If we use US interest rates only as a predictor, will the results be similar?
So average, so what do we mean then by average? Average is, just the average others, okay, versus using the US. No, so as far as I remember doing this, it's important to do the average forward discount rather than just use the US interest rate, because you do need to take out the global business cycle as best you can, right? Because the global business cycle will be in the US interest rate. But of course, the global business cycle moves everybody together, and so there's not going to be anything about the exchange rate. So you have to isolate the US specific component of that time varying exposure. So to the extent that you're picking up global business cycle, you're picking up global inflation, that's going to kind of dirtify these regressions. Noisify, I don't know, these are bad words, they don't exist in English language. But the point is, the regression is going to be less clean. So you want to clean it out of as much of global variation as possible, I think, to make it work.
Okay, there's one last question. How do you think of the emerging markets carry trade? According to Hassan and Manu 2019, carry trade profitability is tied to U.L.P violations. But we know from Bernstein 2014 that evidence against U.L.P is significantly weaker for emerging markets, yet emerging markets carry trades is still very profitable.
Absolutely. So I agree that the U.L.P is closer to holding for emerging markets because why? Because they have a lot of inflation. And in fact, this is one of the reasons why we don't use, and when constructing average forward discount, we don't use emerging countries, is because they have very volatile inflation, and that drives their interest rates in a direction that is more consistent with U.L.P. Because if you have a lot of expected inflation, your interest rate is going to be high, and therefore your currency is going to be expected to depreciate, which is consistent with U.L.P, of course. And to the extent that these countries are trying to fight inflation, interest rates might be overshooting the expected inflation a bit, so it's going to spill over into the real interest rate differentials as well. That said, indeed, carry trade there is profitable on average, and there I think to some extent that has to do with what Adrien showed, that these high interest rate emerging countries, even though they have a high inflation, they load on our global factor, this HML factor. They have high loadings in this factor, and therefore they have high average returns. Also, the average forward discount predicts for emerging countries' exchange rates vis-a-vis the dollar. Now, it has perhaps more to do with what the dollar does than what those foreign emerging country exchange rates do, but it does allow you to predict those exchange rates and extract this time-varying U.I.P. violation profits or time-varying carry trade profits, as opposed to kind of these unconditional ones. So this decomposition into conditional and the conditional risk premia that have to do with the dollar variation and the unconditional ones that have to do with loadings on the kind of HML factor, they do continue to apply to emerging countries, even though it's true that the UIP coefficients are much closer to what they should be if UIP held once you look at the high inflation currencies. Okay, is that it?
Yeah, those were all the questions.
Very good. Again, I'm sorry to everyone for going over time, and thanks a lot for being here. Again, thanks a lot to Adrien for his lecture. Thanks to Nina for helping me set this whole thing up, and thanks to Anna for watching the chat room and the waiting room and relaying the questions. And again, thanks to all of you for being here. Stay tuned. We have 3 more exciting days with 3 more exciting speakers, Alan Taylor, Itamar Drexler, and Lars Luxtor. And we will be posting our slides online, and we'll be posting the videos also for you to watch later if you would like. Thanks again, and see everyone tomorrow.
Thank you, Nick.
Thank you, Adrien. Okay, I have stopped the live stream and I've stopped the recording.